Thanks very much for signing on to this course. I hope you get a lot out of it. I'm Paul Siegel, one of the creators. Spent a lot of time designing and developing courses for organizations around the world and for groups of students. One of the things I've found is it's very important to get engaged with your instructor. What does that mean? That means ask questions. We're here to support you. We try to respond as quickly as possible, and we try to amplify the content on the course. If you're not seeing something such as you want more exercises, you want more videos, that's what we do. We also build custom courses for the largest organizations. So if you're one of those organizations and need that kind of content, just reach out to us. It's easy to find us on the web. We're here to help education become really meaningful, useful, and practical in the day-to-day lives of yourself, you, if you're the student, or your team members, if you're an organization. Thanks very much. See you online.
Welcome to the session on mortgage-backed securities. We're going to introduce you to a variety of the more commonly encountered types of mortgage-backed securities, pass-through securities and CMOs, that is for collateralized mortgage obligations, as well as a lot of the concepts used to assess the attractiveness of mortgage-backed securities and a lot of the details to help understand mortgage-backed securities and how they work. So to give you a brief overview of what to expect over the course of the session, we'll start by introducing, in general, mortgage-backed securities and the debt instruments underlying those securities, which are individual mortgage contracts. Then we'll talk about in detail the original type of mortgage-backed security, which is known as a pass-through security. That'll be a good point at which to introduce some of the unique aspects of mortgages and what causes them to have risks that differ a bit from many other types of securities. That's the uncertainty related to the prepayment, what they call prepayment risk, but also talk about as the embedded optionality or uncertain average life. Then we'll also want to introduce some of the numbers that are used to convey information about rate of return, price, prepayment rates, and so forth. And then towards the end of the session, we'll focus on a different type of mortgage-backed security that is quite a bit more complicated than pass-through securities, and those are the CMOs, or collateralized mortgage obligations I referenced earlier. So to start with a very basic introduction, let's think about exactly what is a mortgage-backed security. And a mortgage-backed security at its simplest level is simply an investment where the cash flows to investors are ultimately coming from mortgage loans. Usually not one. Usually there's a group of mortgage loans held together in some legal entity, oftentimes referred to as a mortgage pool. And these structures can get quite complicated. So sometimes between the payment by the borrower and the cash flow ultimately distributed to the investor, it might wash through more than simply an individual mortgage pool. So we'll touch on some of those more complex structures. But ultimately at base, that's what distinguishes a mortgage-backed security from other sorts of investments. The cash flows to investors are ultimately cash flows being paid by borrowers on their mortgage loans, and that money ultimately, after passing through some number of hands, ends up in the hands of investors. So that's the intervening structures or securitizations reference there. Now, while most of the cash flows payable to investors are those cash flows being paid by the borrowers, but an important element to recognize in many mortgage-backed securities is there might be additional guarantees or credit enhancements. And so we'll have to take those into account where appropriate when trying to estimate the likely future cash flows to investors, whether they're coming from the borrowers or whether defaults or delinquencies by the borrowers are made good from some other source of cash, be it a government or government agency guarantee, some sort of private insurance, or for that matter, cash reserves inside of the structure itself. And as was obvious if you had a chance to think about some of the words spoken up to this point, is that there are risk factors that, well, that's true of any investment, of course, but in addition to facing the same sorts of risks investors and other fixed income securities face, like possibly default risk or the impact of inflation and how that affects the purchasing power of the monies actually paid out to you, mortgage-backed securities have very unique risks. And if we focus for the moment on introducing those unique risks, there are two broad categories. One relates to the uncertainty about how rapidly or how slowly the borrower, known as mortgagor, is going to pay off the loan. And the biggest risk for the high credit quality mortgage-backed securities is in fact that uncertainty about the average life. So we'll want to look at what are the factors that cause that sort of uncertainty and how we might get some sense of whether the rate of prepayment is likely to be high or low and how that will impact the value of our mortgage-backed investment. But then in addition to that, we have to also take into account credit risk. Now, there are certain types of mortgage-backed securities, those backed by a government or government agency guarantee, where credit risk is not that much of a concern. On the other hand, there are many mortgage-backed securities that are not protected by that sort of guarantee, in which case then we have to take into account the particulars of the credit risk. And the credit risk issues then will relate to two broad issues. One is, what is the quality of the loans? And that will have to do with what are referred to as the underwriting standards, how serious the original borrower, I should say the original lender, was in assessing the credit quality of the borrower, and what are those aspects of the loan and the things that affect those sorts of credit risk considerations, like was there a large or small down payment, what sort of income or assets the borrower had to fall back on. In fact, why was the property purchased? Was it purchased for use as a residence, or was it purchased as an investment? And as we'll see later, all of those things go into assessing the credit worthiness or amount of credit risk we think we're exposed to. But then, in addition to that, we also have to take into account what's the impact of any guarantees or credit enhancements in terms of possibly offsetting credit risk issues we feel are tied to the quality of the loans themselves. And here we have a simple diagram, and it's very, very simple, but it tries to capture the idea. Where is the money that's ultimately going to be paid out to the investors coming from? Well, it's ultimately coming from a pool of mortgages, a group of mortgage loans that have been put together, as they say, securitized for this very reason. And of course, those loans are the contracts that the originating lender entered into with the borrower, the buyer of the property, the party that owes the payments under the mortgage, the mortgagor. And so as those mortgagors, the borrowers, make payments on the loan, those monies are passed on through some number of hands. The level of detail we haven't captured here, but will be captured in subsequent exhibits. But then they pass through one or more structures, and ultimately it's primarily the money paid on the part of the borrowers, the principal and interest they have to pay back to pay off the liability. It's those interest and principal payments that ultimately are paid on out to the investors. Although how the investors are sharing in those distributions, well, that depends on the specific type of mortgage-backed security and the terms under which it was issued, and those are some factors we'll talk about further on in the discussion. Now, if we consider the creation, sometimes they'll call the origination of mortgage-backed securities, it's what's referred to as asset securitization. Now, mortgage-backed securities are part of a category of a more inclusive group of what is sometimes called structured securities, because there's a number of different types of structuring or work that goes into creating the security and the underlying and associated legal structures. But the pooling of the mortgage loans for purpose of serving as the ultimate source of cash flow payable to investors, that's what's typically referred to as asset securitization. And that's the most basic sort of structuring that goes on. And that's just pooling together a bunch of mortgage loans, usually very homogeneous loans, although in some instances there might be a variety of different loan types that are pooled together. But in the vast majority of instances, you're looking for loans that are as similar to one another as possible for reasons that will come out as part of the ensuing discussion. And so that asset securitization is the formation of the mortgage pool that will be the ultimate source of cash flows to investors. Now, you might say, well, what's the difference between holding an individual mortgage loan and investing in this pool? Well, there's two broad reasons that would generally cause the securitized loans to be more attractive than the individual loans. One is the benefit of diversification. because by investing in the pool, in effect, you have exposure to all of the loans in the pool. Thus, your investment is diversified across many borrowers as opposed to only one borrower if you were to own a mortgage itself. And the other potential advantage is that, in general, securitized assets are going to be a lot more liquid. Part of the securitization process is structuring these instruments in a form that makes the ownership interest relatively easily transferred to some other party, as opposed to individual mortgage loans. Mortgage loans can be traded between parties, but each loan is in effect a unique document and will require going over in details the particulars of that particular loan. Because of the standardization of these structures and therefore the common features and the common legal framework, it makes the passage of ownership from one holder to a subsequent holder relatively much more simple. And the presumed benefits of these mortgage-backed securities markets don't just accrue to the investors who now have an investment that is diversified and more liquid, but the reason these markets were created and their development was fostered by many governments is that it makes the mortgage market work a lot more efficiently. It's a way of recycling capital back into the mortgage lending system, thus presumably allowing borrowers to obtain funds to buy property more easily, with all the presumed benefit that accords to society, because generally property holders are perceived to be more prudent and responsible citizens. Now, that is one part of the structuring of structured securities. The other part of the structuring is potentially in the payout to investors. Now, the securities we're going to look at first, the pass-through securities, there's no structuring on the back end of the payouts. In pass-through securities, as we'll see, everyone is getting a proportional share of the cash flows. But as we'll see, that gives investors a relatively more difficult time in managing the risk exposure of holding the investment. So some number of years after the first pass-through securities were created, they started structuring the payouts in the back end. And those issues we'll talk about when we get the collateralized mortgage obligation towards the end of the session. The next couple of exhibits will try to give you a visual to support the descriptions I had given you just previously. So this first exhibit tries to give you a sense of both the securitization process and the distribution on pass-through securities. So again, the securitization process is simply a matter of taking the loans, or other credit instruments more generally, but since we're talking about mortgage-backed securities, I'll keep the discussion relatively narrowly focused on mortgage-backed securities. And of course, the mortgage lending business has been around for many centuries anyway. And so at the left-hand portion of this diagram, I have the origination of the loan from some lender, credit union, savings bank, regular commercial bank, insurance company. A wide variety of entities make mortgage loans. And so naturally a buyer wanting to complete the purchase of a home oftentimes has incentive to borrow a significant portion of the purchase price for reasons we'll talk about later. But historically, those loans, like other instruments, oftentimes simply sat as interest-earning assets on the balance sheet of the lender. So if we view this T account as a simplified version of the lender's balance sheet with assets on the left-hand side and liabilities on the right-hand side, well, typically the mortgages would sit as interest-earning assets on the balance sheet of the lender for the entire life of the loan. But for a variety of reasons, starting in around the 1970s, but then expanding over time, you increasingly saw lenders selling those loans to parties that were going to do the securitization, and then investors would buy an interest in that pool of loans. So you can see how the mortgage is passing from the lender who purchased it originally. It was then securitized, the investor then getting an interest in that loan pool in return for handing the money over to the creator of the pool, the syndicator as they're sometimes called. But the top portion of that exhibit is trying to capture the securitization process. The bottom portion is capturing the cash flows to the investors. So once the loan is created, borrowers are expected to make payments periodically, usually monthly, but at different frequencies occasionally, but the vast majority of mortgages are monthly pay instruments. So that money is passed on to, I've got here written loan pool, but there would be some specific legal entity that is where the loans are residing at that point. It might be organized as a trust or corporation, but whatever the legal framework is, the money is being passed through that onto the hands of the investors. And in the straight pass-through securities, every investor is getting their percent participation in each and every dollar that washes through the structure. Now, note, not all the money is passed through, because there's various fees and expenses we'll touch on that are a little bit of runoff of the cash prior to the distribution to the investors, but that cash runoff is actually very, very minimal. So the vast majority of interest and all of the principal paid by the borrowers is going to be paid out to the investors. But you'll notice I have investor A with a 60% interest and investor B with a 40% interest. You'll note I have the line drawn to A showing that investor A is getting 60% of all the principal and interest that's being distributed, exactly their percent participation, and investor B is getting 40% of every dollar of principal and interest being distributed, again exactly in accord with their percent participation in the deal. The next exhibit tries to get to the structuring on the back end when it comes to distribution to the investors. So the securitization can take a number of forms, which we'll talk about later. For the moment, I want to focus on the distribution side here. And you'll note while I referred to the previous securities as pass-through securities, the implication of pass-through is what I was saying it was previously. That's all investors get their percent share, their pro rata share of each and every dollar being distributed. But in the pay-through structures, basically all the money we collect will pay out, again, other than fees and expenses, which is pretty minimal. So basically all the money less the nominal amount of fees and expenses which come out of the interest will now be distributed to investors. But note the difference I have in this drawing of the diagramming of the payout versus what I had for pass-throughs. You'll note in these payout structures, CMOs being a prime example, the collateralized mortgage obligations I've referenced a few times, generally all the investors in the deal, and these could represent three different investors or possibly three different tranches. We'll talk about the implications of that later on. But you'll note in this case, while I've got interest being paid to all investors, the principal is only being returned to investor A, or the investors in tranche A. So this is generally true of all of these tranched or CMO sorts of investments. While the vast majority of investors in the various tranches will be earning some interest, generally not all will be receiving principal simultaneously. Rather, the principal is returned to investors according to some specified priority, and it might be purely a time-based priority, or it might be based on the relative seniority of the different tranches. Again, we'll get into making those distinctions as we talk about the different types of structures over the course of the presentation. But now let's start looking at the most basic level. What is the source of cash flows? Well, again, the source of cash flows are individual mortgages on various types of property. The vast majority of mortgage-backed securities are what they refer to as RMBS. The MBS mortgage-backed securities, the R in this case referring to residential mortgage-backed securities. So the vast majority of mortgage securitizations are based on residential properties. On the other hand, there are also some CMBS, where in this case the C stands for commercial. So there's also commercial mortgage-backed securities, although the bulk of our discussion will be about the more common types, which are the residential. Now, some insight into mortgages and their characteristics and various concepts and ideas that you should be familiar with. The word mortgage actually has two roots. So if we broke it into the appropriate pieces, mort and gage, Mort is a word to us that comes from us by way of Old English, I presume via Norman French, and it has a variety of interpretations, but in this context it means locked or frozen. Gage comes to us by way of Old German and is a word for pledge. So a mortgage contract is a locked pledge. In other words, that debt and that piece of property are inextricably attached to one another until the lien is released. In other words, until the debt is paid off or for some other reason forgiven. To illustrate the idea, let's say I own 4 individual pieces of property, 2 of which were mortgaged. Excuse me. And let's say I want to sell one of the mortgaged properties. But I don't want to pay off the loan because I took it out at a very low rate of interest and a very long repayment period. So I want to sell the property, but I don't want to have to repay the debt immediately. So let's say I go to the borrower, or excuse me, I go to the lender and say, oh, by the way, the property that you had the mortgage on, I've sold that piece of property, but never fear, I have this other more valuable piece of property, which I'm happy to pledge to you as a way of guaranteeing the debt will be paid. Well, guess what? It would be illegal for me to do that, unless, of course, I had negotiated that sort of transaction with the original lender in advance. Because again, given the lock of that debt to the property, there's no ability for me to sell the property until I've paid off the debt or in some other way have gotten the mortgagee, the owner of the mortgage, to release the property from the lien, from the restriction it's under. Now, another aspect of mortgages that you need to be aware of as well is what's the nature of the loan itself, and is the loan considered recourse or non-recourse? And that's a reference to what the lender's rights are should the borrower default on the loan. Because let's say, as is true in, say, many of the states in the United States, that what I have is a, whoops, missed the line there, a non-recourse loan. Well, non-recourse means the lender has no recourse against my other personal assets as the borrower or mortgagee other than repossessing the pledged property or the mortgaged property. But that's the only right the lender has if it's designated as a non-recourse loan, which is very uncommon in most places around the world, but it's actually common in the vast majority of the states in the United States. So no matter how wealthy I am, no matter how many other pieces of property, no matter how much I have in the way of financial assets, if I decide to walk away from that loan, the only recourse the borrower has is repossession of the mortgaged property, but they have no right to go after any of my other personal assets. Now, of course, if it's a recourse loan, which is true in many, many countries, like, for instance, Spain, if I were to default on a property, I end up being liable for the full amount of the unpaid debt, even if the lender has repossessed the property. So clearly, the exposure of the investor or the lender is very heavily affected by whether the loan is considered recourse or non-recourse. And I guess the other thing we should introduce is the different categories of mortgages or ways of categorizing mortgages. And mortgages can be categorized by property type, whether it's residential or commercial. They can be characterized by the loan conditions. Was there a large down payment, a small down payment, no down payment? Was the borrower a prime borrower or a subprime borrower? Is the loan fully amortizing or interest only? Some of those terms we haven't defined yet, but we'll talk about them in some detail later. But those are different loan conditions that would cause loans to be categorized one way or the other. And finally, that reference to conforming or non-conforming. And there's similar concept in many markets around the world, but that terminology is specific to the U.S. mortgage market. And conforming versus non-conforming is a reference to the agency underwriting guidelines we'll look at later. But in general, the only loans that could be securitized by Fannie Mae, Freddie Mac, or Ginnie Mae are conforming mortgage loans. That is, those that satisfy their underwriting guidelines. They have to meet certain terms and conditions. Any loan that didn't satisfy those underwriting guidelines was non-conforming and therefore could not be included in an agency securitization. Still talking about basic concepts and mortgage contract features. Some related issues and terminology. Note the first sub-item there, underwater mortgages. Now, what's an underwater mortgage? An underwater mortgage is simply a mortgage where the loan balance, that is not the amount of the original borrowing, but rather the still remaining unpaid principal. So if the loan balance exceeds the property value, now of course until you sell a property you don't know for sure what it's worth, but this would presumably be therefore an estimated property value. But if the amount of the loan outstanding exceeds the estimated value of the property, that's what causes a loan to be considered underwater. Now, in good economic times, mostly property appreciates, and so this is not a common situation, unless, of course, you run through some problem like in the 1930s or the 1970s, or more recently in the noughties. So that because of significant declines in property value, at the worst of things in the real estate market anyway, something like nearly 1 out of 4 residential real estate mortgages in the United States was underwater. And you've seen similar sorts of percents of borrowers whose loans are upside down. That's another way of referring to an underwater mortgage because the loan is more than the property is worth. It's not an uncommon circumstance in many countries where there was a real estate bubble followed by a real estate crash. So whether you're talking about Spain or Greece or Australia, a wide variety of countries have seen a similar property bubble followed by a crash in property values. Well, a short sale is when you sell a property for less than the amount of the loan outstanding. Now, in many economies, the borrower would still be liable for the amount of the short sale, the amount by which the sales proceeds, which all get turned over to the lender, fall short of the amount of the loan. In some economies, on the other hand, as long as you do a short sale with the lender's okay, then the amount of the loan in excess of the sale price is forgiven. But think about the implications of short sales or mortgage defaults when you have an underwater mortgage, especially if it's a non-recourse loan. In other words, if I have a situation where, say, the amount of the loan, I'll keep going. If I have a situation where the amount of the loan, that is the amount of the loan still outstanding, so I'll say amount of the debt. If I have a situation where the amount of the debt is greater than the property value, remember the definition of an underwater mortgage. Let's say, for instance, I owe $350,000 still outstanding on the loan, and my estimate is the property is only worth $275,000. So there's a specific example of an underwater mortgage. Well, if the loan is non-recourse, I might have some incentive to walk away from that loan. Why do I want to pay off a $350,000 debt to be the owner free and clear of property I only think is worth $275,000? Now, on the other hand, if that's my primary domicile and only domicile, so I have no place else to move by myself, and I don't want to move in with relatives, it might be my best alternative to continue paying on that underwater mortgage. And in fact, most people probably do. On the other hand, if that is a property held for investment purposes, well, then I clearly have incentive to walk away from that loan if it's non-recourse. Because again, why pay $350,000 to become the owner of an investment I only think is worth $275,000? So especially for investor-owned properties where the loan is underwater, they have every incentive to walk away from that loan. But again, depending upon whether the market in which you're operating treats mortgage debt as recourse or non-recourse, that's clearly going to affect both the behavior of the borrowers as well as the way that investors or lenders perceive the risks of the loans that they have made. Now, in terms of types of mortgages, and when we go through cash flows on mortgages later on, I'll be a little bit more specific, but to give you a general idea. The most common type of loan, mortgage loan in the United States is what's known as a fully amortizing. In fact, if the only description you had was an amount, a term, and a rate, like let's say what we had was a $400,000 mortgage loan, so I'll use MTGE as my abbreviation for mortgage. Let's say I was able to take that loan out at a 4.8% rate, and it was simply described as a fixed-rate mortgage. Well, if that's all you get is a rate, an amount, a rate, and a term, I didn't say the term, I should have said 30 years. If all I get is a size, a rate, and a term, and the declaration that it's a fixed rate mortgage, normally what that means is it's a fully amortizing, and also, by the way, level pay mortgage. Level pay or level payment. In other words, the way the contract is determined, they will calculate the amount of the monthly payment that's due month in, month out over the life of the loan. So if it's a 30-year loan, monthly pay, that would be 360 monthly payments. Well, if it's one of these typical fully amortizing mortgages, that means the dollar amount of the monthly payment that's due is the same month in, month out over the entire life of that loan. And if I pay that loan off exactly according to those terms, that is, I make the exact dollar and cent payment that's due month in, month out, so there's no late payments, no prepayments, well, that means by the time I make the last one of those 360 equal monthly payments, not only have I paid all the interest that's due on the loan, I've also fully repaid, i.e. fully amortized the principal. So there's no large payment due at maturity, the way a large payment is typically due on a term corporate bond. On the other hand, there are also what are known as balloon loans. With balloon loans, you actually have, in a sense, two schedules. There is both an amortization schedule. In other words, like I was talking about with that 30-year mortgage a moment ago, there's some schedule by which you're supposed to pay down the debt. But there's also a balloon date. So let's say, for instance, I have a 30-year amortization schedule, but the balloon date is at the end of 5 years. Well, what that would mean is that for the first 60 months, the first 5 years on this balloon, assuming it was a 30-year amortization schedule, I'd be making the same payments for the first 5 years as the person that took out the 30-year fixed rate loan I was talking about previously. The big difference, however, comes on the balloon date. If the balloon date is after 5 years, that means in the 60th month, even though I've only been paying the loan off as if I was going to pay it off over 30 years, at the end of the 5th year, all of the unpaid principal comes due. The amount I have to pay balloons to a much larger amount. And even though you've been paying 5 years on a 30-year loan, probably something more like only 6 or 7% of the principal's likely been paid back. And we'll see the reasons why when we look at the dynamic of mortgage cash flows a little bit later on. And interest only is a very descriptive phrase. On an interest-only loan, that's all you're paying. So we'll show how you calculate the amount of interest that's due on the outstanding principal later. But whatever that amount is, that's the only amount that the borrower has to pay, simply the interest on the principal outstanding. And as long as you don't decide to make an unscheduled principal repayment, that means the interest due would be the same month in, month out, but this doesn't go on forever. Of course, like other mortgage loans, there's a maturity date, and so on an interest-only loan, the full amount borrowed becomes due on the maturity of the loan if all you've paid up to that point is the interest on the outstanding principal. And the last type of mortgage in general that we'll introduce for the moment are what are known as variable rate or adjustable rate mortgages. And they'll talk about two broad categories. They'll talk about ARMs, ARMs, for abbreviation, of course, for adjustable rate mortgages. But they'll also talk about another type of variable rate mortgage known as a hybrid. Well, it's called a hybrid because it's a combination of two things. It's a combination, at least in theory, of part fixed rate mortgage, part adjustable rate mortgage. And usually on these hybrids, there'll be an initial period over which the rate of interest is fixed, maybe 3 or 5 or 7 years. But then beyond that point, the rate is going to reset periodically, either annually or semi-annually. And the cutoff point between, or the difference between adjustable rate and hybrid adjustable rate mortgages is the length of the initial fixed period. If the initial period for which the rate is fixed is a year or less, then it's called an ARM. If the initial period for which the rate fixed is more than 1 year, that's what makes it a hybrid.
Welcome to Introduction to Mortgages and Mortgage-Backed Securities. In this activity, you'll practice identifying loan characteristics, performing financial calculations, and simulating how mortgages are turned into investment securities. The activity includes 5 steps and takes 60 minutes to complete. In step 1, you'll review details of 5 residential loans and identify their key characteristics. In step 2, you'll calculate monthly payments for each loan using a standard amortization formula. In step 3, you'll determine the total value, weighted average interest rate, and average maturity of the loan pool. In step 4, you'll simulate how these loans are packaged into a mortgage-backed security, considering issuer, repayment, and risk. In step 5, you'll reflect on how these securities impact banks and investors. Let's get started and apply what you've learned in a hands-on way.
Let's start looking at mortgage-backed securities and start with the simplest type possible, which is what's known as a pass-through security. And in fact, while we've got a bunch of words here, keep an eye on this page, but let me move forward to the next exhibit so you can look at a picture that tries to breathe some life into these ideas. So the basic building block of any mortgage-backed security is, of course, the mortgage loans, as we talked about previously. And most mortgage loans aren't anywhere near large enough to be the source of cash flow for an individual security. So typically, we're putting lots of mortgages into a pool. If we look at the U.S. agency guidelines, believe it or not, the minimum size pool only has to be $1 million worth of mortgages. Note, that's nowhere close to the size of the typical public offering. The typical public offerings are often in the hundreds of millions, if not north of $1 billion. But the process starts at least with the basic building block being created, which is a mortgage loan agreement being struck by some property buyer or possibly someone who owns the property already and is refinancing, and some mortgage lender. And again, I've got bank and credit union up here, but there's a wide variety of entities that make mortgage loans. And note that the vast majority of property buyers are going to take out a mortgage loan even if they actually are sitting on enough wealth currently to pay for the property in full. So even those who have that much accumulated wealth, or maybe it's the proceeds of the sale of the previous domicile, so they actually have the funds to buy for cash, even such individuals will typically make use of a mortgage loan. Why? Well, in the context of the United States anyway, it's because of the tax advantage. Mortgage interest is one of only 2 types of interest that are tax deductible on an individual's tax return, assuming that you itemize. Now, once upon a time, all interest was deductible, your credit card interest, auto loan interest, personal loan interest. But as a result of tax reform back in the 1980s, most of those allowable deductions were taken away in return for a cut in income tax rates. So at present, only 2 types of interest are legal deductions for individuals on their personal tax returns. That is mortgage interest, money, interest paid on loans borrowed to buy or hold property, and margin interest, money payable on loans that was used to buy or hold securities. So even wealthy home buyers are typically likely to borrow a significant portion of the value of the property. So if we look at the typical situation, the homeowner is putting a down payment of somewhere between maybe 5 and 30% of the property value, but that means the mortgage is likely to represent it's quit on me. The mortgage is likely to represent somewhere between 70 and 95% of the property value. And that's, again, because of the tax benefit. Now, as we said before, up until the 1970s, the vast majority of mortgage loans originated were held by the originating lender as an interest-bearing asset. But starting as a trickle in the early 1970s and growing to a fairly significant volume by the late 70s and early 80s, in fact, to an outright flood by the mid to late 80s, I mean, by that point, somewhere on the order of 85 to 90% of all conforming mortgages, that is, those that were acceptable to satisfy the agency's rules, were being securitized. So what typically happens nowadays for the vast majority of conforming mortgages is after the loans are originated, they're sold to someone who's doing a securitization, which might be a government agency, it might be a financial institution, it might be some other organization that has an interest in mortgages and real estate related issues. So that once that securitization is put together, units of interest are sold to investors, and so that it's now the investors that are the holders of the loan, and the payments made on the loans by the borrowers are passed on to a servicer that we'll talk about later, who in turn passes the money on to the legal entity, the trust account or corporate structure that is the legal vehicle that has the legal title to the mortgages themselves. And that legal entity then, in effect, is being invested in by the investors who are buying the mortgage-backed securities. Now, oftentimes the loans, in fact, in the vast majority of instances, the loan pool you're trying to create, you want to be as homogeneous as possible. It means you want it on the same type of property. You want the same term loans, all 30-year loans, all 15-year loans. You'd like the loans to have a similar rate of interest. Reason for the homogeneity? It's going to make it a bit easier for investors to estimate the rate at which mortgages will prepay. Now, we can't predict that with any certainty, but if we were mixing and matching different types of loans on different properties, commercial and residential, on different maturity loans, some 10-year, some 20-year, some 30-year, on different interest rate loans, some 3.5%, some 4.25%, some 5%. Well, to be able to make any reasonable projection of prepayment, you'd have to have loan-level detail, analyze the economic environment and interest rate impact on those individual loans. Well, especially in large securitizations where there's tens of thousands of loans, having that much detail, first getting it and then being able to manage it and analyze it would be extremely difficult. But by pooling together a bunch of similar loans, that means that all the borrowers are responding to similar incentives with respect to refinancing or housing sales and the like, and therefore we can better assess the likelihood of an increase or decreasing rate of prepayment. Now, if we look at some examples of specific securitizations, some of the larger securitizers of mortgages are the U.S. mortgage agencies. The type of security they had begun issuing is known as the pass-through security, although in the case of Freddie Mac, they actually referred to their variation of pass-through securities as participation certificates. And so you see here a little bit of detail on the U.S. mortgage agencies, which I won't linger on in detail. But you'll note the infrastructure for the secondary market in mortgages in the United States was actually laid in the 1930s. As far back as the 1930s, the government had tried to at least imagine a secondary market in mortgages, and so they had created Ginnie Mae, the Government National Mortgage Association, all the way back in 1936. Now, the mortgage purchase program that they had anticipated never developed in the way they had hoped. So in 1968, they reorganized Ginnie Mae and split it into two pieces, part of which kept the original name, part of which became Fannie Mae, or the Federal National Mortgage Association. And the difference was in the types of mortgages they were intending to securitize. We'll talk about that a little bit later. And Freddie Mac, which originally had a role in supporting the securitization of mortgages from the industry that the Federal Home Loan Bank used to supervise, that was the S&L industry. Well, nowadays that distinction doesn't matter, because as we'll see, Fannie Mae and Freddie Mac are sort of in direct competition with one another. So given their centrality to the operation of the mortgage-backed securities market in the United States, let's look at the agencies in a little bit of detail anyway. And note I have agencies in quotes up at the top, because even though when someone's talking about these three entities, they'll refer to them in the aggregate as the agencies. Literally speaking, only Ginnie Mae is a government agency. Even though when they say the agencies, they're referring to the three in the aggregate, if we want to be technically precise, Fannie Mae and Freddie Mac are not government agencies. They're GSEs, stands for Government-Sponsored Enterprise. So once upon a time, both Fannie Mae and Freddie Mac were government agencies, but decades ago they were privatized, that is, sold off to investors, so that while the federal government owns a few shares in each, the vast majority of the common shares anyway, are owned by private investors. Although, as we'll see, we need to talk about the current status of things because it's actually quite murky. Now, the agency securities are all considered quite safe because they're all backed by guarantees. Ginnie Mae securities backed by the full faith and credit of the U.S. government, and they guarantee timely payment of both interest and principal. Now, it'd be hard to discern what is the exact meaning of that phrase, timely payment of interest and principal, because it's been interpreted by the lawyers in a way that would be different than a normal person would interpret those English words. But what that has been interpreted to mean, timely payment of interest and principal, is that if there's ever a default on a loan in a Ginnie Mae securitization, it won't impact investors at all because that defaulted mortgage is immediately bought back from the mortgage pool by Ginnie Mae. So from the investor's perspective, there's actually an acceleration of the return of principal because all the unpaid principal is returned immediately. Fannie Mae and Freddie Mac, on the other hand, at least technically speaking, only self-guarantee. So that while many market participants had always assumed that while there wasn't an explicit guarantee of Fannie Mae and Freddie Mac like there was in Ginnie Mae, and when I say full faith and credit of the U.S. government, that's exactly the same guarantee that stands behind U.S. Treasury securities. So Ginnie Mae securities are viewed as having no more credit risk than Treasuries. But while many investors believed there was sort of an implicit U.S. government guarantee, there was definitely not an explicit U.S. government guarantee. In fact, even today, while there's a government conservatorship over Fannie Mae and Freddie Mac, which I'll talk about in a little bit, if you go to a Fannie Mae and Freddie Mac website, at least on the page that usually opens up, right at the top of the page in large bold type it says, these securities are not backed by the full faith and credit of the U.S. government. On the other hand, if we look at what actually happened, what happened in the fall of 2008? Well, many investors were getting fearful of holding Fannie Mae and Freddie Mac debt, so to avoid an implosion of the U.S. financial system, the U.S. government, in effect, stepped in and established that conservatorship. So at present, the U.S. government explicitly says they will provide all the cash needed for Fannie Mae and Freddie Mac to continue to carry on their operations. That is the mortgage securitizations, but that's done in the service of expanding home ownership to a wider range of people in the United States. But the history didn't have to unfold as it did, and it was possible the U.S. government would not have bailed out Fannie Mae and Freddie Mac. But given at the point in time where they were getting in trouble, the U.S. government bailed out Fannie and Freddie, not to save investors and their securities, but to avoid a complete collapse of the U.S. financial system. Now, let's actually consider this U.S. government conservatorship over Fannie Mae and Freddie Mac. Because at present, while there are still shares outstanding, the shareholders no longer elect the board of directors. So it's a very unusual board of directors. Unlike most corporate boards that are watching over management to try to make sure management is behaving in a way to maximize shareholder value, that's not what the board of directors at Fannie Mae and Freddie Mac are doing. They're appointed by the Treasury, and their mandate is to minimize losses to those entities, to minimize claims on U.S. taxpayers. So it's not being run for the shareholders' benefit. It's being run for the government's benefit at this point. And if you ever see if you've ever seen any of the testimony that U.S. Treasury officials make when they have to go in front of congressional committees that are making inquiries on these issues, the Treasury officials seem to be talking out of both sides of their mouth. They say, on one hand, yes, we stand ready to provide all the cash Fannie and Freddie need to continue to support their mission to expand home ownership, et cetera. But then when they're asked, oh, does that mean the U.S. government is guaranteeing Fannie Mae and Freddie Mac debt? The response is absolutely not. The government does not guarantee Fannie Mae and Freddie Mac debt. So how is it that the Treasury officials are trying to have it both ways, to speak out of both sides of their mouth simultaneously? Well, they want investors to be willing to hold Fannie and Freddie debt, which is why they say they stand ready to provide all the cash necessary. But the government, that is the U.S. government, does not want to appear as indebted or more indebted than the Greek government, which is why they don't explicitly guarantee Fannie Mae or Freddie Mac debt. Because if it was guaranteed by the government, that would be added on top of the trillions of dollars of outstanding Treasury debt as investors viewed the creditworthiness of the United States. Now, another difference between Ginnie Mae on one hand and Fannie Mae and Freddie Mac on the others is the type of mortgages that will be in their securitizations. Ginnie Mae securitizations can only include mortgages that were originated under one or the other of the various U.S. government mortgage guarantee programs. So FHA, Federal Housing Administration, VA, Veterans Administration, RDA, Rural Development Association. So for a variety of reasons, whether it's helping veterans, people who are in the military own homes, or expanding home ownership in ex-urban areas, or helping people of lesser financial means to get into a home, only mortgages originated under one of those U.S. government mortgage loan programs can actually, only those sorts of mortgages can be in Ginnie Mae securitizations. Now, such government-backed or guaranteed mortgages can be in Fannie and Freddie securitizations, but they account for a minority of loans in the Fannie and Freddie securitizations. The vast majority of mortgage loans in Fannie and Freddie securitizations are what are known as conventional mortgages. What are conventional mortgages? Any mortgage loans originated outside of those government mortgage guarantee programs. Now, some terminology we touched on earlier that I'll just go into in a little bit more depth to give you a better feel or understanding for it. You might remember we talked about conforming versus non-conforming mortgages earlier. And both conforming and non-conforming are in general a reference to these agency underwriting guidelines. So underwriting, that word means many different things, depends on the context in which it's used. But in this context anyway, underwriting guidelines simply refers to what terms or conditions have to be satisfied by the provisions of the loans, mortgage loans, to make them acceptable for inclusion in an agency securitization. So a conforming mortgage loan is a loan that satisfies all the terms and conditions required by these agency underwriting guidelines, which means that security is eligible for inclusion in an agency securitization. So only conforming loans can be inside of the agency securitizations. Note, in some cases, the agencies invested in subprime mortgages, but they could never securitize subprime mortgages because they could only securitize conforming mortgage loans. On the other hand, there are many loans that are not conforming mortgages. That is, their terms and conditions fall outside of or exceed or in some other way do not satisfy the agency underwriting guidelines. Well, if it's a non-conforming mortgage loan, while it can't be securitized by the agencies, there's nothing that prevents private sponsors or originators to create mortgage-backed securities on such loans. And the agency underwriting guidelines touch on a wide variety of factors: size of the loan, size of the down payment, borrower's income versus the amount of the debt. Can they prove the amount of income they're claiming? And as we'll see in a little bit, we'll put some numbers on that and contrast the conforming loans with the non-conforming loans and how that affected securitizations in the mortgage-backed securities market. Let's look more closely at some of the issues as they relate to conforming versus non-conforming mortgages. So you might remember I touched on some of the general issues that determine whether a loan is conforming or non-conforming. Let's be a little bit more specific about the particulars of the guidelines to determine whether a loan is conforming or not. But then let's also look at sort of the complementary non-conforming loan and see how different institutions decide to proceed with their securitization. So one obvious way of assessing mortgage loans is to look at their size. Well, naturally, the government wants the bulk of its programs to be seen to be benefiting the vast majority of the population, the middle classes and lower income classes. government doesn't want its programs to be seen to be primarily benefiting the wealthy or the well-to-do. So there was some maximum size. Now, this was not constant over time. It was tied to an index of residential real estate values. By 2007, when things sort of got frozen a little bit, the maximum permissible size of a loan to be included in an agency securitization was $417,000. Now, of course, while that might buy you a fairly nice home in some parts of the country, in Manhattan, where real estate prices are very expensive, that wouldn't even buy you a modest-sized studio. And the government recognized that, so they actually did put in place in the latter part of the last decade higher limits for high-cost metropolitan areas. And there was actually a 3-tier limit in the highest-cost areas for a while. Mortgages up to as much as $729,250 were acceptable. In other markets, it was up to a little bit above $625, although much of the country was still at $417. And those numbers change over time. But the point is, only loans up to a certain size are eligible for inclusion in an agency securitization. And naturally, in very high-cost areas or for very large homes or properties, a loan of that size would not be anywhere near enough. So there have always been larger loans, and the phrase jumbo mortgage is simply a reference to any mortgage loan that's in excess of the size permissible to make the loan eligible for inclusion in an agency securitization. Now, what do you think about credit quality of those who qualify to borrow jumbo mortgages? Well, naturally, if you're going to borrow more money from the bank has to perceive you as a better credit risk. And that was recognized very early on by the dealers in mortgage-backed securities. So actually, jumbo mortgage loans were one of the first primary sources of securitization for non-agency securities, because the market recognized that high credit quality. And of course, investors, especially absent a government or government agency guarantee, are going to focus more on the credit quality of the loans. Although, as we'll see later on, the high credit quality means these borrowers also have easy access to credit, which means even though jumbo loans are of high credit quality, they might not have very attractive prepayment characteristics. Another criteria for eligibility for inclusion in an agency securitization, you had to be a top-rated borrower. So what they say, an A-rated borrower. Now, A is the highest credit rating for an individual under the U.S. individual credit rating standards. And that's going to be based on things like your history of making your other debt payments, credit card payments, auto loan payments in a timely fashion, haven't declared bankruptcy in the last 7 years, FICO scores and things like that. But as long as the individual or family has all the proper metrics, they can qualify as a prime borrower. Now, of course, there are many borrowers whose quality or whose credit quality is less than pristine. If you have a bad credit record or any credit rating below A, you're considered a subprime borrower. And again, only prime borrowers' loans could be included in the agency securitizations. Although that's not to say subprime loans are necessarily bad. Of course, many of the problems that arose in 2007, 2008 were tied to questionable lending practices and loans made to subprime borrowers. But guess what? Investors were pushing Wall Street to create more subprime mortgage-backed related securities. Why? Well, if you look at the history of the mortgage market from the development of mortgage-backed securities in the 1970s through the mid part of the noughties, 2005, 2006, guess which sorts of mortgage securitizations tended to generate the best returns? Well, guess what? It was subprime mortgage securitizations that had generated the best returns historically, at least through 2005, 2006. So especially because of the low interest rate environment at the time and investors reaching for yield, as they say, a lot of investors were actually pushing Wall Street to create more subprime-related investment because of the historically good returns. Another element of the agency underwriting guidelines is what's referred to as a loan-to-value, oftentimes abbreviated LTV ratio. And the loan-to-value ratio could not be greater than 80%. That is, the amount of the debt could not be more than 80% of the property at the time the loan was made. Well, you'll note this is just a complicated way of saying there's a minimum 20% down payment. Now, there was a variety of ways to meet this. Maybe I put 10% down and then buy credit life insurance on another 10% of the property's value. But in general, you either had to make a 20% down payment or a smaller down payment and some sort of other special action to qualify your loan for inclusion in an agency securitization. Of course, over time, many borrowers would take out loans on property and put down less than 20%. And low down payment loans were okay as far as the lender was concerned, especially if the credit quality of the borrower was deemed good enough. But nonetheless, a low down payment would make the loan ineligible for inclusion in an agency securitization. And then also, you had to be able to document your income in a fashion that was acceptable to meet the agency's guidelines. Generally, that meant provide proof from an employer that you had income, what they call a W-2. Well, guess what? There are many individuals who would not be able to document their income in that fashion. Many self-employed professionals don't have an employer to get a W-2 from. So when you had what they call no-doc loans, that is no documentation of income, as long as the credit quality of the borrower was acceptable, these loans could still be paid off in a timely fashion and still be good grist for securitization. So whenever you see something referred to as Alt-A, that is Alternative A, in other words, this is a loan made to someone who is of high credit quality, they simply were not able to document income in a fashion consistent with the agency underwriting guidelines. Although a word about Alt-A loans. Alt-A loans, at least up until 2004, 2005, meant what I was just saying. It's an individual who, based on a credit assessment of their assets, their credit payment history, their credit scores, was an A-rated credit. They simply couldn't document their income. Starting in about 2004, 2005, underwriting standards in general, not the agency's underwriting guidelines, but the standards banks were using to decide whether or not to make a loan to someone, those standards were being reduced, and reduced. So ultimately, no doc became synonymous with Alt-A. So our Alt-A securitizations made in 2004 or earlier, they tended to have very good credit performance because Alt-A became synonymous with no-doc loans. No-doc loans also were sometimes referred to as liar loans because you could simply assert what your income was. I can remember seeing mortgage originators advertising on TV saying, go online, file your mortgage application, and we'll get you a response as to whether we'll make the loan or not in 15 minutes. Clearly, in 15 minutes, the originating lender could not have been doing a very serious credit assessment. But at the time, most mortgage originators felt, well, we don't care if the loan is a real bad credit risk, because as soon as we make the loan, we'll turn around and sell it to someone else and let the party who buys it through securitization be the one who's got to worry about the credit risk. So the meaning of Alt-A transmuted over time to mean really no documentation of income. Didn't really mean necessarily someone who qualified for an A credit rating. All right, let's say we've got one of those securitization of a pool of loans that are relatively homogeneous. Same maturity, all high credit quality, all have interest rates relatively close to one another. Let's look at how the cash flows move from the borrower all the way through the structures to distribution to the investors. So we'll want to look at the mortgage payments that are made by the borrowers. We'll want to look at the number of hands they pass through, the servicers, and the legal entity that's the legal owner of the loans themselves. Then we'd also like to look at how that money is being distributed to the investors, as well as how that money is characterized from the moment it's paid by the borrowers all the way through distribution to the investors, and then compare how pass-throughs that we will have just looked at in detail contrast to the CMOs that we'll talk about later. So let's consider all those issues I've just overviewed briefly from the previous 2 pages, but let's have a picture to look at while we're talking through those concepts. So periodically, and again, it's usually monthly, although there are mortgage contracts that pay twice a month rather than once a month. And believe it or not, simply making twice as many payments every 15th, middle and the end of every month over the same period of time, it dramatically reduces the interest expense one has to pay. But let's assume this is the most common type of mortgage that is monthly pay. And again, the most common type of mortgage is the fully amortizing mortgage, which each period then requires that the investor make a payment that's going to be deemed part principal and part interest. And you'll note I've got those payments color-coded, so the principal's in P and the principal's in red and the interest is in blue. Now, mind you, note I'm saying here the mortgage payment, the principal and interest might not comprise the entirety of the mortgage payment. Oftentimes, other things have to be included in the monthly payment paid by the borrower. Oftentimes, a proration of the real estate taxes is included, because naturally the owner of the mortgage doesn't want the property repossessed for non-payment of taxes. And especially for borrowers of more questionable creditworthiness or borrowers making a small down payment or first-time home buyers, oftentimes one of the terms of qualifying for the loan is buying some credit life insurance. So the mortgage payment might be more than just the principal and interest, and I'm not going to talk any further about those other possible elements of the mortgage payment because we're interested in mortgage-backed securities, and the only thing the mortgage-backed security holders have the right to receive is the principal and interest. But I did want to make it clear that oftentimes the monthly payment made by the borrower is more than just the interest and principal. And you'll note I've got only a mortgage 1 and a mortgage N. In other words, this mortgage securitization would likely include at least dozens, if not hundreds, and might have thousands or tens of thousands of loans in it. So each of the borrowers are making their periodic or monthly payments of principal and interest and whatever else is included in the payment. Those monies are not paid directly to the legal entity, the trust or corporation that's actually the legal owner of the loans, but rather the money is passed on to a servicer. Servicers are oftentimes the originating lenders, although over time they might sell that servicing contract. But the reason for the servicer is the party holding the loans is not necessarily going to be efficiently organized to collect and process the payments. So they'll rely upon some organization that specializes in loan servicing, something banks regularly do. So the loan servicer receives the mortgage payment, and other parts like proration of taxes or credit life would go elsewhere, but the servicer is going to pass the principal and interest on to the legal entity that owns the mortgages, although you'll note in both cases where I'm showing the explicit cash flows, I show the principal and interest less SF. SF stands for servicing fee, because the servicers receive a fee for handling the monies, to sending out payment notices, to sending out late notices when the payments are not due on time, not paid on time, etc. So the principal and interest on all the loans that we've collected will be paid on to the entity, the trust or corporation that is the legal vehicle that holds the mortgages or the mortgage pool. Now that principal and interest is ultimately going to be paid out to investors, although you'll note that not all the money is being paid on, because there is both the service fee that's kept by the servicers, and there's oftentimes something known as an excess spread that is kept by the sponsor, the entity that created the mortgage pool, because of course they have various administrative fees and expenses they have to pay. But then once we've taken off those fees and expenses or excess spread, the principal and interest remaining, and you'll note all the fees and spread come out of the interest. All the principal we collect on the loans will be paid out to investors, as well as all of the interest, less the fees and spread we've cited previously. And in a pass-through security, there is a pro-rata distribution of all funds. That is, and these are the same numbers I had in an earlier example. Let's say the entirety of the investment was acquired by two investors. And investor A having a 60% interest, investor B having a 40% interest. Now, mind you, they don't express interest in that fashion in the mortgage-backed securities world. Interests are expressed in terms of an original face amount and a factor that tells you what percent of the original principal is still outstanding. So if, say, for instance, this mortgage pool was a $10 million mortgage pool, that is $10 million, say, that would mean if investor A has a 60% interest, investor A has the right to receive $6 million of the $10 million of principal that's owed on all of the mortgages in the pool. And since investor B has a 40% interest, that means investor B has the right to receive $4 million of the $10 million of principal outstanding at the time of the securitization. And even still, I'm simplifying it, because if we had a large number of mortgage loans, it's very unlikely that they would come to an exact round dollar amount. It's probably $10,236.62. I'm not going to go to the trouble of calculating the 60 and 40% of that odd dollar and cent figure. So more conceptual here. But the point is that if A has a 60% interest and B has a 40% interest, that means A receives 60% of all dollars of principal we've collected from the investors. Because remember, there's no expense met out of the principal. All the principal we collect from the borrowers will be used to make a return of principal distribution of the investors. So since A has a 60% interest, they'll get 60% of all the principal we've collected, whether it's paid on time or prepaid. What about late payments? Well, if this is an agency securitization, there are no late payments, because one of the agency guarantees is that if there are any delinquent payments by the borrowers, the agencies will advance those payments on behalf of the delinquent borrowers. And similarly, investor B, since they have a 40% interest, gets 40 cents on every dollar of principal collected, whether paid on time or prepaid. And they also get the same proportional share of the interest income, although again, it's not a straight pass-through of all the interest income. They're getting the same coupon rate. We'll talk about the pass-through rate in just a few minutes. But if they get the same pass-through rate, the same interest rate, well, A's getting it on 60% of the principal, B's getting it on 40% of the principal, so they're getting their same respective percent participations in both the interest and the principal. And one last item. Note the color coding I used. That's because in these structures, whatever the money was characterized when it was part of the payment made by the borrower on their loan. And we'll show a little bit later on how you determine what portion of the payment is the interest due on the outstanding principal and what portion of each payment is going to pay off, i.e. amortize the principal. Well, in pass-through structures, money carries that characteristic all the way through to distribution to the investor. So money that's paid as a repayment of principal by the borrower is the only source of money to make a return of principal distribution to the investors. And money paid as a payment of interest on the outstanding principal by the borrowers, that is the only money that can be used to pay fees and expenses. And out of what's left, that's the money that is used to make an interest distribution to investors. So you have that straight proportional distribution and retention of original characterization of the money. Now, why did I bother to be so explicit about that? Isn't that the way it always works? Well, no. Once you get past pass-throughs, it doesn't work that way any longer. On CMOs, money does not have to retain its original characteristic. So money we collect as a repayment of principal might be used to make a return of principal distribution or might be used to pay interest. And money we collect as a payment of interest might be used to make an interest payment to investors, but money we collect as interest from a borrower might also be used to make a return of principal payment to an investor on a CMO. And remember what we also said earlier about the structuring of the payouts in the CMOs. While all the investment classes in a CMO might be getting interest payments periodically, will generally only be returning principal to one class of investors, whichever class has the priority to receive the return of principal at that time. Okay, let's look at some of the issues investors would assess to try to get some insight into things like prepayment rate, whether it's likely to be faster or slower going forward, or cash flows to investors, things of that sort. Well, some of the metrics that are used to convey information about the mortgage pool and therefore some of the investment characteristics of this specific mortgage-backed security are what they call the WAC and the WAM and the WALA. And in each case, WA, at the beginning of the acronym, stands for weighted average. And the weighting, in effect, is what percent of the principal on any one loan is as a percent of all of the principal currently outstanding. So this is a dynamic number. This weighting changes over time as some homes are sold and the mortgage is paid off, or some loans are refinanced. Or for that matter, on some loans, the borrower is making partial prepayments. So these weights are not constant. each month they recalibrate by looking at the outstanding principal on each loan in a given month, and what is that as a percent of all the principal outstanding on all the loans in the pool. So you're multiplying that factor either times, well, the interest rate on the loan, that's what they call the WAC, or the weighted average coupon. That's the weighted average interest rate on all the loans in the pool. Or the WAM, weighted average maturity. In other words, typically in months, what's the amount of time till the longest maturity loan on average? And voila, what's the weighted average loan age? Now, as a for instance, let's say we've got a pool that has a pass-through rate of, well, I don't know, let's say 4%. I referenced this in passing earlier on, but the pass-through rate is basically the coupon rate on the mortgage-backed security. That's the interest the investor is expecting to get as a percent of the principal that they're collecting interest on. And remember, on a pass-through, that's never going to be the original principal except in the first month, because these are typically amortizing mortgages, so the amount of principal you're collecting that fixed interest rate on will be declining over time. That's, by the way, is what is the implication of a pass-through rate. It's the rate of interest that's being paid on a declining principal balance. Well, let's say we want to compare the WAC to the pass-through. Now remember, per the earlier discussion, there's some runoff. There's a servicing fee to be paid. There's an excess spread being kept by the sponsor, because they'll have administrative fees and expenses, or guarantees that they're trying to fund, like a cash reserve, or in the case of the agencies, that's how the agencies would fund their guarantee, from the excess spread. Well, if the pass-through rate is 4%, the weighted average coupon is, and of course, going to have to be above that amount. In fact, the agency guidelines specify that a minimum, the lowest interest rate on a loan in the pool has to be at least 25 basis points, or in other words, 1/4% above whatever the pass-through rate is. But maybe if the pass-through rate is 4%, maybe the weighted average coupon is something like, oh, I don't know, say 4.63%. But that's what we'd expect. We'd expect to see the weighted average coupon well in excess of the coupon rate. And we know this is likely to decline over time. Why would it decline over time? Well, which mortgage loans have will the borrowers have the greatest incentive to pay off? Well, unsurprisingly, the highest interest rate mortgages are the ones that are likely to be paid off first. So on balance, we know that the weighted average coupon is likely to decline over time. Now, as far as weighted average maturity, you might think that if this is a securitization of 30-year loans, the weighted average maturity would likely be 360 months, because that's the number of months in 30 years. Well, guess what? 30 years, if it's a pool of 30-year mortgage loans, would have been the term at the origination of the loan. And while most loans that are going to get securitized are securitized almost immediately after they're originated, not necessarily. Sometimes banks or mortgage lenders more generally will sit on a loan for a month or 2 or 3, or sometimes for 2 or 3 or 5 years before they decide to securitize it. So every securitization of 30-year mortgage loans I've ever seen, I've never seen one with 360 years. Typically, the weighted average maturity at origination is something like 358 or 359 months, because invariably, a few of the loans being securitized were held by the lender for a few months or maybe a few years before they got securitized. And while it might be nice to know when the final payment is due on average, actually what's more insightful to trying to get some sense of likely future prepayment rates is how old is the loan. So weighted average loan age, which tells you how long the loans have been in existence, that's likely to give you more insight into what the prepayment rate is likely to be than what's the time until the final payment is due. And a little bit more on the pass-through rate beyond the general description I gave already. Note that that interest rate is payable on the principal outstanding at the beginning of the month on an agency securitization. That's what they call guaranteed interest, because even if, say, someone were to pay off the loan sometime during the month, they would only owe interest up until the date the loan was finally paid off. But as a way of making investors have greater certainty about the cash flows, on agency pass-throughs, you're going to get the pass-through rate on the principal outstanding going into the month, even if some of those loans were paid off during the course of the month. And finally, what you're getting the pass-through rate on is the current outstanding principal. So if we have a pass-through rate of 4%, which in decimal terms will be 0.04. So if we have a pass-through rate of 4%, let's say the original face amount on the security we have was, say, 100,000. But remember, what you get the interest on is the currently outstanding principal. And the currently outstanding principal is the original face amount times the pool factor. Well, let's say we had a pool factor of 0.985. Well, 0.985 in decimal terms, that's equivalent to 98.5% in percentage terms. Well, that's exactly what that means. That factor of 0.985 would tell us that 98.5% of the original principal was still outstanding, which means that if we had an original face amount of 100,000, the factor times the original face amount says, oh, the currently outstanding principal is 98,500. And that's what we'd be earning our 4% rate of interest on. Not in the original face, but rather the currently outstanding amount of principal. Now, as far as mortgage payments, we touched on this previously. So you heard it in words, but here you see it in words as well. So remember, the mortgage payment will always include the principal and interest owed, but there might be some other inclusions like proration of real estate taxes or credit life insurance. And there are penalties for late payments. There are some cases penalties for prepayments, but a specific discussion of the penalties is beyond the scope of what we intend to talk about here. But let's look at the actual amount of the monthly payment. So what you see up here is the formula for calculating the payment for every month. So when I say MP sub j, that's the monthly payment for the jth month. In other words, whether it's the first month, the 17th month, the 93rd month, the 156th month, the 217th month, all the way up to the 360th month, you'll note the monthly payment is going to be the same. The monthly payment is going to be the same because the monthly payment is based on the mortgage balance at time zero. So the amount of the borrowing obviously doesn't change. It's just the unpaid balance will change over time. But since the monthly payment is premised on the original amount borrowed, that means the scheduled monthly payment is exactly the same month in, month out over the entire life of the contract if it's the standard fully amortizing level pay mortgage. So even if you make a partial prepayment, it doesn't change the amount that's due the next month because the amount due is the same every month. And for those of you with some background in financial mathematics, you might recognize that formula. That formula is the formula for a fixed annuity period certain. In other words, we're trying to determine what constant payment over a set period of time would be adequate to pay off the initial value of the loan, in other words, the amount of the borrowing. So the way we'll compute the monthly payment is take that original mortgage balance, multiply it by 1 plus I, where I is the periodic rate of interest. So by convention, we always express interest rates on an annual basis. But when it comes to calculating value or cash flow consequences, you always have to convert that annual rate to its periodic equivalent. So if we had an annual rate, say, of 6%, well, the periodic rate, the plug-in for I, wouldn't be 0.06. Rather, it would be 6% divided by 12, which, of course, is equal to 1/2 of 1%. Although if we want to work in decimals, which are much easier to work with, in decimal terms, 1/2 of 1% would be 0.005. So that's the I. The I is the annual rate converted to its periodic equivalent. So you're taking 1 plus the periodic rate to the n power, where n is the number of payment periods, times I, that's the same I as in there, the periodic rate, and all of that is divided by 1 plus I raised to the n, that same factor in the numerator and denominator, although now in the denominator it's minus 1. But again, this is the formula for computing a fixed annuity period certain. In other words, what's the constant dollar payment that would have to be made period in, period out over the length of time, in this case 30 years or 360 months, to fully equal the initial value of the loan. Okay, let's investigate that formula in a little bit more detail, plug some numbers into it from some hypothetical mortgage contract, calculate the amount of the monthly payment, and then do a couple of things with that. Both look at how we determine what portion of the payment is treated as interest due on the outstanding principal, as well as what portion of the payment will be deemed repayment of principal. And then ultimately look at, well, what's the consequence of pooling mortgages and how that impacts cash flows to investors. So you'll note here the same formula we were just talking about. But now, just below that, we have the formula fleshed out with numbers consistent with this example. So for example, we're using a $400,000 30-year mortgage with an annual interest rate of 4.8%. So that means my initial mortgage balance is the amount borrowed, $400,000. The number of periods we're going to use is 360 because while it's a 30-year loan, since we're assuming monthly pay, 30 years times 12 months a year is where we get the 360 payment periods. And the periodic interest rate we're going to use is going to be 0.4% or 0.004 in decimal terms because, again, we normally express rates on an annual basis, but anytime you're calculating value or cash flow consequences, you want to convert the quoted annual rate into its periodic equivalent, which we do by taking the annual rate and dividing by the number of periods. So you'll note that I now have the correct values slotted in the appropriate points in the formula. Now, if all you had was a handheld calculator that would add, subtract, multiply, and divide, this would be quite laborious. But even a handheld calculator with the right financial functions built in, like even something as ancient as an HP 12C, which at this point is probably 30-plus-year-old technology, we could handle this sort of computation. And so you'll note that the amount of the monthly payment that's due is $2,098.66, and that's the amount that will be due every month, now through, well, whatever time period the loan is paid off in full. And that means even if we make a partial prepayment of principal, it doesn't cause the lender to go back and recalibrate the amortization schedule so all future payments will be lower. The same payment is due each month. The only impact of a partial prepayment is it will shorten the life of the loan, because you only owe interest on the amount of principal for the length of time that principal is outstanding. So every dollar of principal you prepay, you owe no more interest on that dollar of principal. So that's the impact of partial prepayments, not reducing future payments due, but simply shortening the life of the loan because you're reducing the total amount of interest that will be payable over the life of that contract. So this exhibit tries to give you a visual that shows the split between interest and principal of those monthly payments and how that will vary over time. So you'll note we have the total amount of the monthly payment due represented by that horizontal black line near the top of the diagram. That's at a vertical height of $2,098.66, the amount that's due month in, month out over the life of the contract. Well, imagine, if you will, this diagram, but divided up into vertical slices. So 360 vertical slices, one representing each month over the life of the contract. So a vertical slice here to the left representing the first month's payment, a vertical slice way over here to the right end of the diagram representing the last or 360 months payment, and say one somewhere here towards the middle representing, say, the halfway point, the 180th month. So I'm only going to draw those three slices, but imagine this divided up into 360 vertical slices, each one representing one of the monthly payments. Well, the vertical distance from the horizontal axis to the blue curvilinear line, that represents the amount of interest that's due on the outstanding principal month by month by month over the life of the loan. By the way, this is assuming no prepayments or no late payments. And then the vertical distance from the blue curvilinear line to that red ceiling, that represents the amount of interest, I should say the amount of principal repayment month by month by month over the life of the loan. So you can see how in the early years of the life of the mortgage, the majority of what you're paying is going to pay interest on the outstanding principal, and only a relatively smaller portion of each payment is going towards amortizing or repaying, returning some of the principal. And even halfway through the life of the loan, while you're returning more principal, or more of your monthly payment is considered return of principal, still the bulk of what you're paying is interest on the outstanding principal. It's only in the later years of the life of the loan where a majority of the payment is actually going to pay down the debt. And while this is the visual, let's actually look at some numbers that try to convey the same idea in terms of the loan payments and the principal amortization. So in this diagram, you see numbers consistent with, say, the first 3 months of loan payments. So you'll note here we have the same dollar amount computed in our $400,000 30-year loan with a 4.8% annual rate. And you'll note the same payment is due every month. Because again, the amount of the payment is a function of the original principal, not the current outstanding principal. So the payment is constant over time. The amount of interest is computed by taking the periodic rate, our 4.8%, or 0.048 in decimal terms, divided by 12 to give us a periodic rate of 0.4%, or 0.004 in decimal terms. Well, the periodic rate times the currently outstanding principal is what determines the amount of interest that's owed on the outstanding principal. So note how we get what portion of the payment is deemed return of principal. We take the total payment, or total amount paid, subtract from that the interest due on the outstanding principal. Whatever is the residue, whatever remains, that portion of the payment is all that's treated as return of principal. Well, you'll note now when it comes to the second month's payment, whatever amount of principal was repaid in the first month, that's the amount we'll be subtracting from the principal balance going into the month to get the principal outstanding at the beginning of the next month. So when we make our second month's payment of $2,098.66, again, we determine the interest owed by taking the current outstanding principal and multiplying that by the periodic rate of interest. That tells us how much interest is due on the outstanding principal in the second month. Subtract that from the principal payment. What we're left with is what's deemed return of principal. Again, we'll subtract that amount from the principal going into that month to determine what's the amount of principal outstanding at the beginning of month 3, and so forth and so on. Now, remember I made a comment about partial prepayment of principal. What happens if in the second month, rather than paying $2,098, we paid $4,098? So we won the lottery. We paid an extra $2,000 towards our mortgage. Note that doesn't change the interest due on the outstanding principal going into that month, so the only impact was the entire amount of additional money tossed into the mortgage payment will be treated as return of principal. So consequently, when we go to calculate the next month's principal, we'd be subtracting $2,500.65. In other words, we'd only have $397,000.69 of principal still outstanding. But guess how much money would be due in the next payment? Again, the monthly payment doesn't change. The only impact of a partial prepayment is not that it reduces future monthly payments. Rather, because it reduces the amount of interest we'll owe over the life of the loan, it shortens the life of the loan. Well, let's consider not the cash flows on an individual mortgage, but the cash flows on a mortgage pool, and look at some of the consequences of pooling mortgage loans. Now, let's say that mortgage we talked about before, $400,000, 30 years, 4.8%. What happens if that loan was pooled with 999 other loans with exactly the same terms. So they were, in other words, we had 1,000 loans, each of $400,000, each with a 30-year term, each with a 4.8% rate of interest. Obviously, that's an oversimplification, but remember, when they build the mortgage pools, they're typically putting together loans with the same term, with similar interest rates. So it really isn't that far of a distinction from what we see in real securitizations. Well, you'll note that would mean that the picture of scheduled payments is exactly the same. It's just that the scale of the vertical axis would be different, because now, rather than getting the payment on one loan, we'd be getting the payments on 1,000 loans. So in other words, the monthly payment would be 1,000 times the monthly payment on one of the loans with those terms. So what we have here is a picture of the scheduled monthly payments on a pool of mortgages. But what's the implicit prepayment rate in that diagram? Well, of course, if that's the scheduled payments, that would imply a 0 prepayment rate. What's the likelihood that on a pool of 1,000 loans we'd have a 0 prepayment rate? Well, the probability is approximately 0. Because even if interest rates did nothing but rise after these loans were originated, which means no one has incentive to refinance to improve the terms of the loan, to cut the interest rate or shorten the life of the loan or something like that. Oh, some people might still do cash-out refis, because the easiest funds they have accessible is by borrowing against the, say, equity buildup in the property. But especially in a rising rate environment, that would not likely be a large number of such loans. But even in the absence of incentive to refinance, you're still going to see some considerable prepayment on mortgages. Why? Well, on conventional mortgages in the U.S., mortgages have a due on sale clause. Someone sells the home, they have to pay off the loan. That's the first use of the proceeds. They only have use of the proceeds in excess of what it takes to pay off the loan. So this picture tells us almost nothing about the actual cash flow on a pool of mortgages. We'd actually have to try to estimate or forecast some prepayment rate. And let's look at the complications or implications of that. Now you'll note I've got the same diagram as on the previous page, but superimposed over that, I have several dashed lines. The implications of those dashed lines are how the cash flows would change under some assumed prepayment rate. Now, we'll talk about prepayment benchmarks and prepayment models later, but if we simply saw something like the average mortality, that is sort of the average pace at which mortgages prepay over time, well, the dashed green line, and in fact the vertical distance from the horizontal axis to the dashed green line, that is now representative of our estimate of the total cash flows on this pool of mortgages based on some assumed prepayment rate. So again, if we split this into 360 vertical slices, the one to the far left representing the first month's cash flow, the one to the far right representing the final or 360th month's cash flow, et cetera, et cetera, et cetera. Well, you'll note what this assumed prepayment rate is showing is a relatively low level of prepayments for the first 2 or 3 years. That has historically been the case under most circumstances anyway. But then under normal circumstances, while prepayment rates tend to be low for 2 or 3 years, after that they start rising fairly significantly. Why? Well, people's lives change. Sometimes rates go down and homeowners have the opportunity to refinance. But other homeowners have additions to the family. They need to move into a bigger home. Others have become empty nesters because the kids have moved away. They want to move into a smaller place. Some people have job offers they want to take advantage of across town or across country, so they want to have a better commute. They move. So for a variety of reasons, mortgage prepayments will tend to start to rise 2 to 3 years after origination. They'll tend to peak somewhere between 5 or 7 years after origination before prepayment rates start falling off. And so you'll note that what these lines represent is from the horizontal line, horizontal axis to the blue dashed line, that represents the interest portion of each month's payment, or cash flows coming off the pool of mortgages. And the vertical distance from the dashed blue line to the dashed green line, that represents our estimate of the amount of principal we'll be collecting, again, month by month by month over the entire 30 years or 360 months. So you'll note initially I'm showing cash flows just a little bit above the amount we would have been receiving had there been no prepayments. And since there's only been a little bit of prepayment in the early months, the total interest we'd be collecting is simply a little bit below the amount we would be receiving again in the absence of prepayments. But then after a couple of years, as prepayments start to rise, so the total cash flows are well in excess of what we'd be getting had we been getting only the scheduled payments. Well, as those prepayments start to rise, the total dollars of interest we collect go well below what we would have been receiving had there been no prepayments. And note by the very end, in the final years of the life of a 30-year pool of mortgages, chances are 80 or 90% or 95% or more of the mortgages have already paid off for some reason, whether it's a housing sale, a refinancing, foreclosure, or whatever. So in the final years of a 30-year mortgage securitization, the cash flows will be relatively de minimis, given the huge amount of prepayments that were likely to have happened earlier on. Now consider what we know about mortgage cash flows. Do we know the amount of principal that we're going to collect, not in any one month, but period by period or cumulatively over the life of the pool? Or alternatively, do we know the amount of interest we're going to collect? And naturally, if we knew both the amount of principal we were going to receive and the amount of interest we were going to receive, we'd know the total cash flows that we would receive. Again, not in any one month, but cumulatively over the life of the pool. Well, guess what? The amount of principal should be known, because generally pass-throughs are either done on high-quality mortgages or backed up by a government or agency guarantee. And so if the loan is going to be paid off, if not by the borrower, then it's likely to be made good through one of those guarantees. But the interest is something we obviously can't know, because we're uncertain about the prepayment rate, and interest is only due on principal outstanding for as long as it's outstanding. And this is the very uncertainty we're talking about here. We can't be certain about the rate at which mortgages are going to prepay. And since we can't know the amount of interest, we obviously can't know the total cash flows we'll receive over the life of the investment as well. But given what we can know, the amount of principal, well then if I had a good eye and a steady hand, the area between the solid black and blue lines, which that area represents the principal when only the scheduled payments are received, that should be the same as the area between the dashed blue and the dashed green lines, because those represent the same amount of principal, simply being returned at a different rate because of some prepayment rate. And given this projection is based on some prepayment rate, and we'll talk about how to quantify prepayments in just a little bit, how long is that projected prepayment rate good for? Are we going to live with that projection for the next year, next quarter, next month, week, day, hour? Well, of course it depends on what you're doing and why you're doing it. So maybe if I'm an academic that's making some general studies of prepayment rates, maybe I simply get updated prepayment rates once a quarter, once a month, maybe only once a year. But if you're living or working in a trading environment, say you're sitting on a mortgage-backed securities trading desk, like a quotation, a prepayment projection is good only for the moment it's given. In fact, in a volatile interest rate environment where rates are moving up or down by 5, 10, 15 basis points a day, we might adjust our prepayment forecasts numerous times over the course of the day. Let's look at mortgage prepayments in a bit more detail. Because again, if you have either a mortgage pool of very high credit quality, or a mortgage pool that's backed by a government or government agency guarantee, credit risk is really not the biggest risk you're facing. Rather, it's the uncertain average life that would result from a high or a lower than anticipated rate of prepayment. So what are the factors that drive prepayment? I've touched on some in passing, but let's look at them in a somewhat more organized fashion. The biggest driver of mortgage prepayments is normally going to be interest rates. Specifically, what is the current mortgage rate? And by current mortgage rate, I mean the rate at which you could take out a mortgage loan today. And it's going to be that versus the existing rate. And by existing mortgage rate, I mean the rate that people are paying on the outstanding mortgage loans. And that comparison is likely to give the most insight as to whether mortgages will prepaying at a relatively high or low rate. Because obviously, to the extent that current mortgage rates are below the rates people are paying on their existing loans, as long as current rates are far enough below the existing contract rates to make it worth your while to go through the time, effort, and expense of refinancing, changing mortgage rates are probably the biggest driver of prepayment rates. Mortgage rates rise, prepayment rates are likely to slow down, both because of an absence of refinancing incentives, as well as the fact that when interest rates go up, it also makes housing sales activity slow down. Because while you might think of the cost of property as the purchase price of the home, for many home buyers, that's the size of the monthly payment they have to make. So even if you hold housing prices constant, if interest rates rise, that means higher monthly payments. So rising interest rates will generally cause prepayment rates to decline, both because it reduces refinancing incentives as well as causes a slowdown in housing sales activity. Note, falling interest rates have the opposite impact, of course. And if interest rates decline dramatically, there's likely to be a tremendous outpouring of refinancing activity as people with existing loans try to take advantage of that opportunity to cut the interest rates they're paying on their loans. But similarly, falling interest rates will tend to drive housing activity up as well because, again, given the impact lower interest rates will have on the size of the monthly payment, housing sales activity generally increases as mortgage rates decline. But beyond simply considering the interest rates on mortgages for either refinancing or housing sales activity, a number of other factors have an impact as well. So there's demographic considerations, in other words, considerations relating to the population, and a whole bunch of things. Things like what's the number of households and new household formation? What's the sort of the age composition of the population? For a relatively older population, the demand for housing is going to be relatively small and maybe contracting. Whereas for a young, burgeoning population, the demand for housing is likely to increase dramatically. Also, there's financial or economic considerations, both at the individual level and economy-wide level. So at an individual level, of course, your ability to buy a home depends on your financial resources. So most prepayment models, that is models that try to attempt to forecast prepayment rates, will look at some measure of consumers' purchasing power, whether it's disposable income or wealth or some similar sort of thing. But in addition to individual levels, individual financial economic considerations of that sort, there's also general economic considerations. Because one's willingness to buy a house is not purely a function of my existing savings or current income, but it also might be affected by my perception of the strength or weakness of the economy. If I think the economy is very strong, well, I wouldn't even worry if my employer goes out of business, because I think there'll be many other job opportunities to take advantage of, so I'd have the cash flow, the income to make the mortgage payment. On the other hand, when the economy is very weak, even if I'm feeling fairly comfortable and safe in my job, in a very uncertain economic environment, it's very hard to forecast the future. And especially if the unemployment rate is rising, existing workers might feel that they're hesitant to take on the expense or the obligation of a 30-year mortgage when they're fearful that if they were to lose their job because their employer's business turns down, they might not have an easy time finding a job to supplement or have income to pay off the loan. And even seasonal considerations have an impact, because it doesn't matter so much where the weather is relatively moderate or warm most of the year around, but especially in northern climes, you tend to see distinct seasonal fluctuations in the demand for housing. Because if you're living in the northern tier of North America or Europe, housing activity tends to slow down quite a bit in the winter, as people don't like to trudge through the snow looking at housing, nor do they want to think about moving in the midst of winter and possibly having their life complicated with a snowstorm. So prepayment rates tend to be relatively low through the course of the winter. They'll tend to rise a bit in the spring going into the summer. They tend to actually fall off a bit in the middle of the summer due to vacation reasons. And then prepayment rates tend to pick up again in the late summer, early fall, before falling off going into the winter again. So there's a variety of factors that will impact prepayment rates. And remember the metrics we looked at earlier that I said investors use to get some insight into the investment characteristics of a mortgage pool. Specifically, let's look at the WAC and the WALA in a little bit more detail. Now, remember what we said the WACC was. Weighted average coupon is the metric that gives you the weighted average interest rate on all the loans in the mortgage pool. And the reason that's important, of course, is for, in part at least, for trying to assess prepayment rates or prepayment risk. Because while knowing the pass-through rate is good, because that tells you what your cash flow is going to be as a percent of the still outstanding principal, but mortgagors don't decide to refinance or not refinance based on what portion of their interest is being paid out to investors. But mortgagors will decide to refinance or not refinance by looking at the rate they're actually paying on their loan. So that's one of the reasons why it's important to know the WACC, because it gives us some insight into the rate at which one pool will prepay relative to another. And just to be a little bit more explicit about that, let's say we were looking at two pools, both of which had a 4% pass-through rate. So PTR for pass-through rate, that's simply the interest rate that's payable to holders of the pass-through security. But while both of the pools have, say, a 4% pass-through rate, let's say when we look at their respective WACCs, let's say one of those pools has a WACC of 463, like the WACC I hypothesized some time ago. But let's say there's another 4% pass-through pool that has a weighted average coupon of 4.78%. And let's say rates were currently up in the 6% range but coming down. Which of those two pools is likely to see its prepayment rate pick up sooner? Well, of course, the one with the higher weighted average coupon, because on balance, there are higher interest rate mortgages in that pool. Thus, that pool will tend to see its prepayment rate rise sooner. Now, mind you, if rates just keep coming down and coming down, eventually the other pool will also, or the mortgagors in the other pool will also have incentive to refinance. So ultimately, the second one would catch up. But if we wanted to know which was likely to see its prepayment rate earlier, of the two pools, the one with the higher weighted average coupon is likely to see its prepayment rate rise sooner. And note the word here, burnout. Burnout is a reference to an absence of an increase in prepayment when rates come down. Because naturally, interest rates can move in a variety of fashions over time. So let's say we have a diagram here that has the mortgage interest rate. I'll just say rate, but by that I mean, I'll say mortgage rate. So by that I mean the interest rate on mortgages that one could take out currently. And let's say the horizontal axis represents time. And let's say we're looking at this pool that has the weighted average coupon of, let's say this is the one with the weighted average coupon of 4.78%. So that horizontal line represents that 4.78%. Well, what happens if mortgage rates decline? So let's say we're up here and mortgage rates are declining over time. They dip below the weighted average coupon, so we see some pickup in prepayment rates. But then rates move back up. That, of course, as rates move up, it removes the incentive for people to refinance once mortgage rates go back above the rate they're paying on their existing loans. Well, what happens if rates come down again? Well, note, the second time rates decline, as the rates dip below the weighted average coupon, you're not likely to see the same pickup in prepayment rates. Why? Many of those who could have refinanced would have done so at the earlier opportunity. So the likelihood is that the only time we'll see a significant increase in the prepayment rates on this pool is if rates end up going lower than they previously went. So those mortgagors who had lower rate mortgage contracts who didn't have incentive to refinance when rates dipped originally because rates didn't go far enough, it's only when rates dropped to a lower level than they had achieved previously that those borrowers previously not able to profitably take advantage of the opportunity to refinance would now have the opportunity to do so. But you'll note the initial decline of rates below the weighted average coupon would not result in the same spike in prepayment rates because of what's referred to as burnout. People that had those higher rate mortgages would have already have refinanced.
Welcome to Pass-Through Securities. In this activity, you'll practice applying concepts from agency underwriting, mortgage pool analysis, and prepayment behavior. The activity includes 5 steps and takes 60 minutes to complete. In step 1, you'll identify agency underwriting criteria that determine loan eligibility.
In step 2, you'll calculate monthly payments for a pool of 3 mortgage loans. In step 3, you'll compute the monthly pass-through cash flow that investors receive. In step 4, you'll explore the impact of an early loan prepayment on investor returns. In step 5, you'll compare agency and non-agency pass-through securities. Let's get started and apply what you've learned in a hands-on way.
Let's think about the investment characteristics of pass-through securities. So let's look a little bit more closely at expected risks and returns and the factors that might impact those expected risks and returns. So first off, it's a good idea to get a solid handle on how to think of risk. Because all too often people that don't have the benefit of a formal financial education associate risk with bad. And that's not the right way to think about it. Risk doesn't mean bad, risk means uncertainty. So for instance, a low-risk investment is in truth one where your maximum loss, no matter how bad things get, is likely to be a relatively small loss. On the other hand, in a low-risk investment, if things are really good, there's not much upside. So no matter how good things are, you're probably not going to get a small positive return. So the right way to think of a low-risk investment is an investment that has a very narrow range of likely future outcomes. Small downside no matter how bad things are, small upside no matter how good things are. Whereas a high-risk investment is one that has a huge range of possible future outcomes. Big downside if things are really bad, but big upside if things are really good. Now, mind you, on those high-risk investments, most of the outcomes will still be in the middle of the distribution. It's just there's a lot more tail risk, a lot more potential for extremely big returns, big positive returns, or extremely big negative returns. So don't think of risk as bad or negative. Think of risk as uncertainty. So what are the factors that cause our future returns to be uncertain? Well, in part, for mortgage-backed securities, it's pretty much the same standard risks investors in all types of fixed income securities have to face, although maybe to some varying degrees. For instance, default or credit risk is generally minimal on pass-through securities, because pass-through securities usually have very high underwriting standards for the mortgage loans eligible for inclusion, and oftentimes will have some government or government agency guarantee. The price risk, on the other hand, the duration and convexity, which we'll talk about in a little bit, well, that's sort of an odd trade-off for mortgage-backed securities because, in effect, there's an implicit call. Since each mortgagor generally has the right to prepay their mortgage, that's like a portion of the bond being retired early, called early in the parlance of the bond business. Reinvestment risk, here's something you face to a very high degree with mortgage-backed securities because you have lots of cash flows to reinvest. Not only are there monthly cash flows, but remember you're getting amortization of principal as well. So there's lots of money to reinvest at unknown future interest rates, so mortgage-backed securities have a higher level of reinvestment risk than typical corporate or government bonds. Purchasing power risk, or the risk associated with the uncertainty of your purchasing power, it's not that you face them to a significantly different degree here than with other securities. And liquidity, well, that's an issue. It depends on what you're trading and how you're trading them. Generally, mortgage-backed securities are relatively illiquid unless what you're doing is what's referred to as TBA trading. So if you're trading agency securities on what's known as a TBA basis, well, in that context, mortgage-backed securities are relatively liquid. But unfortunately, if you're trading something else, chances are the liquidity will be relatively minimal. But let's consider this MBS, the mortgage-backed securities specific risks, prepayment risk, and the impact that's going to have on the average life of the investment. This is what I've also previously referred to as embedded optionality or uncertain average life. And one thing you can be fairly certain of with mortgage-backed securities as an investor is that the average life of the investment is going to change in the wrong direction. Why? Well, consider who has the right to decide whether to prepay or not prepay the loan. The borrower is the one who gets to decide to prepay or not prepay. So let's say I make an investment at some particular rate, And let's say, for instance, I'm able to make an investment in mortgage-backed securities at something like a 4% rate. So I own some mortgage-backed security paying 4%. What happens if from the 4% level rates go up? Let's say rates rise from 4% to 5% on mortgage-backed securities. Well, of course, if I had invested my money at 4% and rates are now at 5%, I'd like to get my money back as soon as possible to get out of that old lower rate investment and redeploy my capital into a higher interest rate paying investment. But guess what? I can't force the money to come back any sooner. And in fact, per what we said earlier about the way borrowers behave, as rates go up, mortgagors are likely to repay their mortgages as slowly as possible. Because now the loans they took out at that old lower rate of interest represent really attractive financing compared to current borrowing costs. So when rates rise, and I'm looking at this from the standpoint of an investor, if when rates rise, that's exactly the time I'd like to get my money back sooner, I can be sure, given the way borrowers are likely to behave, that I'm going to get my money back more slowly than anticipated, exactly when I want it back sooner. And conversely, what happens if rates fall after I make this investment at 4%? Let's say rates decline down to, say, something like 3%. Well, now, of course, I'd like to hold that 4% interest rate investment for as long as possible, because now that's a very attractive level of income compared to the rate at which I could invest currently. But guess what? Exactly when I'd like to leave my money tied up for as long as possible at that old higher interest rate, that's most likely the circumstance under which more of my principal is going to be returned more rapidly. Because at that significantly lower market rate of interest, many of the borrowers who took out loans at 4% could refinance. That is, take out a new loan at 3%, use the proceeds to pay off the loan they took out at 4%. And that results in the acceleration of return of principal to me as the investor. So exactly when I'd like to hold on to this high interest rate investment for as long as possible, I'm going to get my money back sooner than anticipated. And this is not just theoretic. I'll give you a real world example. In the spring of 2003, the 30-year mortgage rate dropped from something like 6.75% down to something like 5.25% in a matter of something like 6 weeks or a month and a half. So in a month and a half, the market went from 6 3/4 to 5.25%. Well, as you might imagine, as rates came down so significantly, mortgagors took the opportunity to refinance at that much lower rate. So many investors who had made investments in newly originated mortgage-backed securities in late 02 or early 03 thinking, oh, I probably won't get half of my money back for 13, 15, maybe not for 17 years on a securitization of 30-year mortgages. But given the significant decline in rates in a short period of time, mortgages originated over the previous 6 months or a year, the borrowers were facing a huge incentive to refinance. So there was a number of mortgage securitizations late the previous year or earlier that year where the investors got back half, got back 50% of their principal in the very first year. And imagine how unattractive that was, because the very thing that motivated the repayments meant that as an investor, all this money I hadn't anticipated receiving so soon, I was now facing very unattractive reinvestment prospects because rates had declined so precipitously. So the point being about that embedded optionality is we know the average life is likely to change, but given that it's mortgagors, the borrowers that have the right to prepay or not prepay, I can be pretty sure that the average life of the investment is going to change in the wrong direction. When rates go up and I'd like my money back sooner, the average life of the investment is likely to lengthen, meaning my money's tied up for longer than I would have previously anticipated. And if rates go down, when I'd like to leave my money invested for as long as possible at that old higher interest rate, well, if there's a significant decline in rates, the average life of the investment is likely to shorten dramatically, which means I'll be forced to reinvest more money at relatively unattractive lower interest rates. Right. The sources of return for mortgage-backed securities are similar to those that they are for any fixed income security. Cash flows, reinvestment income on those cash flows, and changes in price. But note with a pass-through security, we've got a couple of issues there. One is, of course, that there's a greater amount of cash flow to be reinvested compared to more typical corporate or government bonds, so you have more reinvestment risk. And also, mortgage-backed securities have pricing that, well, relative to yield changes, it's going to be a lot like other callable bonds, that is negative convexity, which we'll look at more closely in a little bit. But those are probably the two big issues with mortgage-backed securities and the way they differ from other investments, other than the uncertain average life we talked about previously. A lot of reinvestment risk and negative convexity, which we'll talk about in a little bit more detail. And note this last subheading here, yield versus rate of return. Now, one of the complications with any profession is industry jargon and the way people use it. But note by return, they typically mean rate of return. That is relative to my investment, how rapidly is it growing if I have a positive return, how rapidly is it shrinking if I have a negative return over time. Now, yield is a very problematic word because it has so many potential meanings. And oftentimes used by itself, it's another way of saying rate of return. But oftentimes the word yield is used as a reference to the interest rate that you use to express the value of a security. So if you hear someone saying Treasury securities are yielding or mortgage-backed securities are yielding, that clearly can't be a reference to rate of return, because that we can only know after the fact. When you hear yield used in that sense, a mortgage-backed security is yielding or trading at a yield of, it's not some promised future rate of return, it's simply the interest rate that's used as a way of expressing the value of the security today. And we'll see what I mean in the context of pricing conventions, because when you're pricing mortgage-backed securities, it's not like pricing a regular Treasury or corporate security, because those typically have a fixed coupon. So I know what the cash flows are going to be per period. They have set maturity dates, and so consequently I know when the end point in that stream of cash flows occur. So pricing and valuing Treasury or corporate securities is relatively straightforward compared to mortgage-backed securities. Because with mortgage-backed securities, well, as we'll see in the formula, we're still going to try to take a present value of cash flows. But remember, with mortgage-backed securities, we can't know what the cash flows are going to be. So we will project cash flows using some pricing speed, that is some PSA or CPR speed we'll talk about in just a little bit, that's a way of expressing the rate at which mortgage cash flows will prepay. And the yield we were talking about before, well, when you talk about corporate or municipal or government securities, they talk about a yield to maturity. With mortgage-backed securities, the similar concept is what's known as a cash flow yield, which we'll talk about presently. So here you see the mathematical frameworks by which we relate price to yield. Again, yield not as in rate of return, but yield as the interest rate that expresses the value of a security. So for some Treasury security, the price is the periodic cash flows, the semi-annual coupon payments that are fixed by the coupon rate on the security. And of course, along with the final coupon payment, we'll get the full face amount, the par value, because Treasuries are term securities, all the principal returned at once at maturity. And we can calculate the price by dividing or discounting the cash flows by 1 plus the yield to maturity expressed as a periodic rate. You'll note the formula for mortgage-backed securities looks relatively similar, but there's some clear distinctions. Because you'll note now in the numerator, I have CF sub 1 for the cash flow due at the end of the first period, say the first month, CF sub 2 for the cash flow due in the second period, et cetera, et cetera, et cetera, all the way up to the cash flows due 1 period prior to the stated maturity, and in fact the cash flow at maturity. But you'll note these are not references to fixed coupons or some par amount, because what the investor is receiving with each of these monthly cash flows is a combination of 3 things. The pass-through rate, or the coupon rate, which you're getting on the outstanding principal, the principal a portion of each of the scheduled monthly payments, that's the amortized principal, but probably in every month there's going to be some prepaid principal, even in the very first month, because some mortgagors will be making partial principal prepayments from the very beginning. So each of these cash flows are a combination of each of those three elements. Guess which of those we can know? Well, the only thing we can know is the coupon payment due in the first month, because we know how much principal was outstanding going into the first month, and we can know the scheduled principal amortization in the first month. But since we can't know the prepaid principal in the first month, we can't know CF sub 1, and therefore we can't know any of the cash flows with certainty. Because even the subsequent coupon payments are coupons on the outstanding principal going into that month, and the only month we can know the principal outstanding with certainty is the very first month. So basically all of those cash flows are projections based on some assumed prepayment rate. And the way you end up calculating the yield, that is the interest rate that expresses the value of the security, is by taking the cash flows, which, remember, we don't know with certainty, but they're projected at the pricing speed being used by the dealer. And we're going to talk about ways of expressing prepayment rates or pricing speeds using PSA or CPR in just a few moments. The price we can know if it's a quoted security, and if we're getting a pricing speed from the dealer, we can get a price quote from the dealer as well. But guess where these I's come from? Those I's are solved for via an iterative process. We're simply solving for what single value of I causes the present value of the cash flows projected at the dealer's pricing speed to be equal to the quoted price. So it's clearly not very appropriate to think of these I's as a yield as in rate of return. This is simply the yield as in the interest rate that expresses the value of the security. And remember, each of those I's, in effect, is a monthly figure if these are monthly cash flows. So the way you get the annual yield to maturity is the way you get this for any typical fixed income security. You take the periodic rate and multiply by the number of periods. So whatever is, assuming these are monthly cash flows, whatever is the value of I for those monthly cash flows, we simply multiply the monthly rate by 12 to get the annual rate. Naturally, if we're trying to understand mortgage-backed securities as investments, we have to get some sense of what the likely future cash flows are and how rapidly or how slowly they're likely to come in. So prepayments is extremely important for purposes of valuations. And with regard to returns, it relates to my comments previously about the uncertain average life. Because while mortgage-backed securities always trade at yields above the yields on similar maturity Treasury securities, they don't necessarily generate higher returns because of the way the average life is going to change. Especially in a falling rate environment, which you normally think of as good for fixed income investors, that's where investors in treasuries are likely to dramatically outperform mortgage-backed securities. Because when interest rates decline, given the absence of embedded options in U.S. Treasury securities, the only impact of those declining interest rates is to increase the present value of the future cash flows. But remember, per our earlier discussions, if interest rates decline dramatically, mortgage prepayments are likely to increase and potentially dramatically, and therefore investors' returns are likely to be very adversely affected by the fact they're forced to reinvest cash flows in that lower interest rate environment. Rising interest rates aren't good for mortgages either, because you might say, oh, that slows down the prepayment rate. That's true. But that means I'm now getting a below market interest rate, because remember we just said interest rates rose. I'd be getting a low market interest rate for a longer period of time. So in general, investors in mortgage-backed securities will only outperform investors in similar maturity treasuries by a good margin if interest rates are relatively range-bound in a fairly narrow range. But significant increases or decreases in interest rates will likely cause mortgage-backed security holders to underperform. Now, with respect to pricing mortgage-backed securities, it's similar to the process for pricing bonds, but it's a bit more complicated. Because with regular fixed coupon bonds, it's simply the present value of those fixed future cash flows. With callable securities, it gets a little bit more complicated because they might be quoted on a yield to call or yield to maturity basis, and which it is outside of the scope of a discussion of mortgage-backed securities. But I might end up either pricing the securities to their maturity or pricing them to call, depending upon the level of interest rates in the market versus the coupon rate on the bond. But with mortgage-backed securities, not only do you have that uncertainty about whether or not the bonds will be called, we know that there's going to be some level of prepayment, but we know the level of prepayment is hard to predict, and it's going to change in a way that's adverse to our interest as investors because the mortgagors hold the option to prepay. So if we consider the cash flows and valuation, with mortgage-backed securities, like other callable securities, they exhibit negative convexity. And we'll look at a diagram of that in just a few moments, so I'll save a more in-depth discussion of convexity, especially until we have a picture in front of us to illustrate the concepts to supplement the words. But another aspect that's not obvious to people on first blush when looking at mortgage-backed securities is how the price of the security might impact your ultimate return and how prepayments will interact with that current pricing. Because note, if I buy a discount mortgage-backed security, that means I'm paying a price less than par. Say, for instance, I'm buying a mortgage-backed security at a price of something like 92% of its par value. Implication of that? Well, the implication of that is I'm in effect buying the mortgage for 92 cents for every dollar of principal still outstanding. Why would I get to buy it for less than 100 cents per dollar? Well, because interest rates have risen since that mortgage-backed security was originated. It's paying a below market rate of interest. That's why it's trading at a discount. But think of the impact of a rise in prepayments. When somebody prepays, they have to prepay their loan by paying 100 cents on every dollar of principal they're trying to pay. Well, you'll note to the extent prepayments pick up, I'm realizing the capital gain, the difference between the price I paid and the price the loan is paid off at. Now, it might not be paid off until the maturity of the loan, but my point is if prepayments increase, I'll be capturing that capital gain more rapidly than anticipated. So if I own a discount security, an increase in prepayment rates actually has a slightly positive impact. Note, on the other hand, if prepayment rates slow down, that means I'm going to earn that capital gain more slowly than anticipated. That's a negative. And of course, those relationships are reversed for mortgage-backed securities trading at a premium. Trading at a premium, of course, means the security is trading at a price above par. Maybe something like, say a mortgage-backed security trading at 107. The implications of that is that I'm paying 107 cents for each $1 of principal. Why am I willing to pay more than the face amount, the amount of the loan? Well, because these mortgages carry an above market rate of interest. So I'm expecting them to prepay somewhat rapidly, but I'm willing to overpay in a sense, pay more than 100 cents on the dollar, because I'm going to capture this above market rate of interest for at least some period of time. Note now, if prepayment rates increase, that's a bad thing, unlike what I said for discount securities, because if prepayment rates increase, that means I'm collecting that above market interest rate for a shorter period of time than I anticipated, or saying the same thing another way, I'm suffering the capital loss more rapidly than anticipated. If you have MBS at a premium, a slowdown in prepayments is actually generally a positive. Another consideration is the aging of the mortgages themselves. Why is that a consideration? Well, the older a pool of mortgage is, the more stable the prepayment rates will be. And in general, the more predictable the future cash flows on any investment, the safer that will be considered. But there's other factors aside from aging. And there's all sorts of things. Rural areas, there tends to be lower turnover in the housing stock than urban areas. So mortgages originated in South Dakota are likely to prepay more slowly than mortgages in Southern California. The size of the loan will have an impact on the incentive to refinance, because when you refinance, it's not simply how much you can cut your rate by taking out a new mortgage loan, but it's also the size of the loan upon which you're cutting that rate. So saving 1% is a lot more valuable to someone who's got a $1 million loan than someone who's got a $50,000 loan. And a number of other factors, but that's enough to give you some sense. And if we look at the relative yields, Remember the earlier discussion of Ginnie Mae securitizations, and I said Ginnie Mae securities have the same backing as do Treasury securities. Both Ginnie Mae's and Treasuries are backed by the full faith and credit of the U.S. government. And yet if we were to consider the yield on Ginnie Mae securities versus the yield on, say, a 10-year T-note, which is oftentimes used as a generic benchmark for mortgage-backed securities, you might say, well, why are 30-year mortgages comparable to 10-year T-notes? Well, remember, most mortgages prepay to some extent, and it turns out if you look at the multi-decade average, the average life of a 30-year mortgage loan over the last 4 or 5 decades is approximately 10 years. Well, in today's environment, a 10-year T-note might be trading at a yield of something like 2.5%, and a Ginnie Mae security might be trading at a yield of something like, I don't know, say 3.9%. What's the implication of that significant difference in yields? If they're both backed, that is Ginnie Mae's and Treasuries, backed by the full faith and credit of the U.S. government, why would similar life investments trade at such dramatically different yields? Is that an indication the market really doesn't believe the U.S. government stands behind Ginnie Mae every bit as fully as it does the Treasury? No, the market believes the government guarantee is the same for the two. So what explains the difference in yield? Well, remember, Treasuries have fixed cash flows. Fixed coupons, fixed principal, due at specific dates, and there's no embedded call options. But we've spent some good bit of time talking about the uncertainty of the average life of mortgage-backed securities, which includes Ginnie Mae, and that's the primary driver of that spread in yields, is the investing community will view the uncertainty of the average life as causing Ginnie Mae, and knowing it's going to change in the wrong direction, will cause investors to view Ginnie Mae's as dramatically riskier than Treasuries. Not riskier in a credit risk sense, but riskier in the sense that the average life is uncertain. Oh, a little piece of that difference is because Ginnie Mae's aren't anywhere near as liquid as Treasuries, but the vast majority of that spread between their yields is due to that embedded optionality, or also called prepayment risk, or the uncertain average life we've been talking about. Let's go back to a consideration of the pricing dynamics of mortgage-backed securities. You might remember I said that mortgage-backed securities, like other callable securities, exhibit negative convexity. Well, what does that mean? Well, consider the two diagrams on this exhibit. The one on the left-hand side of the exhibit would be true as this blue curvilinear function reflects the price-yield trade-off. That is, how is the price going to change given some change in yield? In all non-callable securities like Treasuries, like non-callable corporates, exhibit positive convexity. And what's the implication of positive convexity? Well, consider the starting price and yield implied by this diagram. So P star, the initial price, and Y star, the initial yield. Again, yield not as the rate of return, but yield as in the interest rate that expresses value. Well, what happens if yields go up by some number of basis points? Say that's 50 basis points. Well, if yields go up by that amount, the price is likely to decline by that amount, at least as described by that diagram. But that's what everyone learns first about the number side of fixed income business. Prices and yields move inversely from one another. But what many of you might not have known is what happens if yields go up again by the same number, say another 50 basis points. Well, you'll note if yield goes up again, the price goes down again. But you'll note that even though the second yield increase was the same as the first yield increase, the price decline after the second yield increase was smaller than the price decline after the first yield increase. And you'll note since we're measuring price along the vertical axis, you can see by the slope of the price-yield function that the slope of the price-yield function is flattening out as you go to higher and higher levels of yield. And since we're measuring price on the vertical axis, a flatter function means a less sensitive price. So you'll note for non-callable securities, as rates rise, the sensitivity of price to an interest rate change declines. And conversely, as rates are falling, you see that each time rates fall by the same number of basis points, the price appreciation gets greater and greater and greater. So for non-callable bonds, prices get less sensitive to rate changes as rates are rising, moving against us. So that yes, as rates go up, we lose more and more we lose, but we lose more and more slowly. Conversely, as rates go down, not only get price appreciation, but the steepening of the slope of the price yield function means that our price gains are accelerating as yields decline. In other words, when yields fall, the price becomes more and more sensitive to a rate change. But you'll note that positive convexity, and it's called positive convexity because the price-yield trade-off works in favor of the investor. But when you got mortgage-backed securities, like other callable securities, they exhibit negative convexity. You'll note, given, again, some starting point, a P star and Y star that represents the initial price and yield at which the security is trading. In this case, what happens when yields fall? Well, if yields fall by some number of basis points, we get some price appreciation. What happens if yields fall again by the same number of basis points? Well, we get appreciation again, but less appreciation than when we realized after the first yield decline. Because you'll note that unlike the diagram for non-callable bonds, when you have callable securities, including mortgage-backed securities, pass-throughs and others, as rates go down, the price is getting less and less sensitive to an interest rate change. Why the negative convexity? Why the flattening of the price gains when yields are falling? Well, it's the very fact that these mortgage loans are prepayable. In other words, the mortgage-backed securities are subject to partial calls as the mortgagors, the borrowers, decide to prepay, that is return principal, faster than is required by the mortgage contract. So the existence of those embedded call options place an effective ceiling on how much these securities are likely to appreciate. And it's bad the other direction as well, because what happens if rates are rising? Well, as rates rise, each time rates rise, you're getting larger and larger price declines. Because again, here as rates go up, you see a steepening of the price slope function, which means as yields are rising, which means as an investor owning mortgage-backed securities long, we're suffering losses as yields go up. Well, our losses are accelerating. And mind you, this isn't a death spiral, because once rates go up enough, this negative convex curve swings over to positive convex, but that only happens after these securities are trading at significant discounts to par. Not at 97 or 95% of par, but probably more like 83 or 78% of par. So note that the trade-off is very bad from the mortgage-backed security investor's perspective. As yield is dropping, causing our price to appreciate, our price sensitivity is getting less and less. That is, our gains are accruing more slowly. And when yields are rising, since the price is becoming more and more sensitive to interest rate changes, our price losses are accelerating. So it's a very unhappy trade-off from the investor's perspective. That's one of the reasons why that slope of the price yield function is referred to as a negative convexity. Now, we talked about quantifying prepayment speed before conceptually. Let's look into the mechanics of expressing prepayment speeds. The two most common ways of expressing prepayment rates in the U.S. mortgage-backed securities market is either CPR, because these are usually expressed by acronym. Now, CPR stands for conditional prepayment rate. And you might notice I put a little bit of emphasis on conditional when I said that, because many people mistakenly refer to CPR as constant prepayment rate. Well, the confusion is understandable because CPR assumes a constant prepayment rate. It assumes the same prepayment rate period in, period out going forward. But the proper way of referring to it is conditional prepayment rate. It's called that. Why? Well, future cash flows are conditional on prepayments in the earlier periods. So it probably doesn't hurt to call it constant prepayment rate because that's what CPR implies. But if you wanted to sound knowledgeable about the subject, you'll refer to it as conditional prepayment rate. And the other common way, and by the way, that's used globally, but it's commonly used in the U.S. as well. But the other common convention in the United States is what's known as PSA, standing for, well, it's an acronym for Public Securities Association. And as you might guess by the name, that was an industry trade group. Because when the mortgage-backed securities market started here in the United States, the initial mortgage securitizations were Ginnie Mae. They came out in 1970, and you didn't have Freddie Mac's until 74 and Fannie Mae's until 81 or something like that. And since Ginnie Mae's or Ginnie Mae is a government agency, the dealers in Ginnie Mae securities associated with the other dealers in public securities, governments and municipals. But it's an organization that we don't need to talk about. The only importance for us here is that they came up with this prepayment benchmark. Note there are others. Rather than assuming a single prepayment speed over time, sometimes originators of mortgage-backed securities will specify a schedule of CPRs. That's different CPRs, month in, month out, over some period of time. Or there's also home equity prepayment, which they refer to as HEP. So there's others that are used currently, and there's other types that were used historically. I won't talk about the historic methodologies. They're up there just for a matter of historical interest, but they're not used at all any longer, so I'm not going to talk about them in any detail. But now let's look a little bit inside of these methodologies for expressing prepayment rates. And if you look at PSA, the PSA prepayment benchmark, all PSA speeds would have the same generic diagram, the same sort of profile. That is that PSA speeds always assume a constant steady increase in the prepayment rate over the first 30 months. And after 30 months, they'll assume a constant conditional prepayment rate. Now, you can express PSA speeds in a wide variety of metrics, 25% of PSA, 150% of PSA, but they all scale off of what is known as PSA standard, also called 100% PSA. And 100% PSA has a terminal conditional prepayment rate, that is the assumed constant conditional prepayment rate from the 30th month and beyond at 6%, and the first 30 months, what they call the ramp, is a constant steady increase up to that 6% rate. By implication, the prepayment rate, the CPR, is increasing by 0.2% a month, month in, month out for the first 30 months, and then beyond 30 months it's constant. The implication of any PSA speed other than PSA standard, in effect, it's a multiplier. So if I were to say something like, I have a mortgage pool that is prepaying at the rate of, say, 186% PSA, well, think about how you could alternatively express 186%. I could also express it as 1.86 times and that's the right way to interpret that number. 186% PSA simply means whatever conditional prepayment rate is implied at PSA standard. To get the CPR at 186% of PSA, you'd multiply the PSA standard values by 1.86 times. So if we look more closely at the PSA benchmark, you might remember I referred to part of the previous diagram as the ramp. That is that period of the first 30 months where the prepayment is rising at a constant speed. That's try to capture the aging or seasoning of mortgages. Because when you have a pool of newly originated loans, initially the prepayment rate will be almost zero, and it's going to rise at an unpredictable and a fairly substantial rate over the first 2 to 3 years. And that's what that 30-month ramp is supposed to try to capture, the seasoning or aging of the mortgage pool. So the way you get the ramp speeds in general is you'll take the terminal conditional prepayment rate, that's the rate that's supposed to be constant from the 30th month and beyond, and divide it by the length of the ramp. So remember I said with PSA standard the terminal prepayment rate is 6%. So if I divide that by 30 months, that means the increase in the CPR per month over the first 2.5 years will be 0.2%. So in other words, in the first month we'll assume a conditional prepayment rate of 0.2% CPR. That's if we're using PSA standard. After 6 months, it would be 1.2%. After 15 months, 3%. You're just multiplying whatever number month you're in by the monthly step up. So if we consider the PSA benchmark, again, what we have is a schedule of conditional prepayment rates, constant after the 30th month, but gradually rising from 0 to 6% at PSA standard. And remember my earlier comment that any PSA speed is really scaling off of PSA standard. So here we see written into the outline what I had assumed earlier. What happens if we're using a PSA speed of 186% of PSA? Well, that simply means whatever the value in that month would have been at PSA standard, we're going to multiply that PSA standard value by 1.86 times to get the CPR at that 186% PSA. Now, if you're going to try to project cash flows using some prepayment rate, remember I said that there's several widely used methodologies. Those methodologies are either PSA, the PSA benchmark we've been talking about more recently, or CPR. But note that if you give a prepayment speed in PSA, you'd first have to convert that PSA speed into what conditional prepayment rate is implied by what month you're in and whatever PSA speed you're using. And once you have that conditional prepayment rate, either because you inferred it from the PSA speed, or maybe you're expressing prepayments on a CPR basis, even once you have the CPR, you're not done yet. Because the CPR you have, whether that's how the speed was expressed or you inferred the CPR speed from the PSA speed, you have to convert the CPR speed into what's known as an SMM, which stands for single monthly mortality. And by mortality in this case we mean what percent of the outstanding principal would have prepaid in that month. And that's the factor that we're going to have to use to actually project the amount of principal prepaid. But a word of warning here. I've seen a number of basic books on mortgage-backed securities that refer to things like PSA and CPR as prepayment models. And you'll note, up till now, I've been very careful to refer to them as prepayment benchmarks. In other words, PSA and CPR are ways of expressing a prepayment rate. What's a prepayment model? Well, a prepayment model is an econometric or statistical construct that's based on historic correlations between prepayment rates and changes in the significant factors, economic or financial or demographic, that have an impact on prepayment rates. Remember our earlier discussion of what factors cause prepayment rates to increase or decrease. So by looking at the history of variations in mortgage prepayments and studying how those correlate with changes in things like mortgage contract rates, that is the rates on new mortgages, consumer wealth or disposable income, even the time of the year, remember seasonal prepayment variations. Well, our prepayment model will take into account the historic correlations between changes in those factors and changes in mortgage prepayment rates. Well, that's what a prepayment model does. PSA and CPR are not prepayment models. They're ways of expressing prepayment rates, but neither PSA or CPR give you the tools to actually discover what those prepayment rates might be. CPR nor PSA give you the tools to look at what's the WAC, what's the WAM, what's our expectations for economic growth and all the other factors that might be inputs in the prepayment models, and somehow digest all that information and come up with a number. That's what prepayment models do. So why do we express speed using PSA or CPR when we actually estimate speed using prepayment models? Well, because prepayment models are potentially very valuable. Firms spend lots of resources, a lot of people's time and the supporting technology and money to try to come up with methodologies for making better projections of prepayment rates and how they might change over time. And as you might imagine, to the extent that you can make better estimates of future prepayment rates, that gives you a better ability to estimate and recognize value in securities that might be overvalued or undervalued. So since firms spend a lot of resources to develop those proprietary prepayment models, they're not just going to give away the store. That's why while they'll use prepayment models to actually estimate the rate at which a pool of mortgages will prepay, will not disclose the details or insights of our model. We'll re-express that into some PSA or CPR or PSA or some other way of expressing prepayment rates as a way of not giving away valuable information. So let's look at the diagram of 3 PSA speeds. Remember PSA standard, that terminal prepayment rate of 6%, I have that as the middle of the 3 profiles. Well, we looked at 186% PSA before. What does that imply about the terminal prepayment rate? Well, the terminal prepayment rate we get by taking the terminal prepayment rate at PSA standard and multiplying by 1.86, reflecting the multiplier implied by 186% PSA. Well, that gives us a terminal prepayment rate at 186% of PSA of 11.16%. And what are the ramp speeds? Well, if I divide 11.16 by 30, the number of months in the ramp, that would tell me the monthly step up. Or what's going to be the terminal prepayment rate at 65% of PSA? Well, I simply multiply the 6% terminal rate for PSA standard by 0.65, the multiplier implied by the 65% of PSA. That tells me the terminal prepayment rate at 65% PSA is going to be a conditional prepayment rate of 0.39%. And again, I get the monthly step up in the ramp by dividing the terminal prepayment rate by the number of months in the ramp. But think about the implications of the PSA benchmark. No matter what prepayment speed you're assuming, other than a 0% prepayment rate, which remember I said is never going to happen, the nature of the PSA benchmark is the highest cash flow will always be projected for the 30th month. Not that that's reality, that's simply the nature of the PSA benchmark, because remember, it assumes a steadily increasing prepayment rate for the first 30 months, and after 30 months it assumes a constant prepayment rate. But remember, you'd be applying that constant prepayment rate to an ever-declining principal balance. These are amortizing securities, remember. So I'm not trying to tell you that the highest monthly cash flow will always be in month 30. That's simply the nature of the PSA benchmark. But that should give you a very strong word of warning to not place too much weight on any quoted yield in mortgage-backed securities, because that's based on cash flows projected at the dealer's pricing speed. And anytime they use a PSA speed, by implication, they're projecting the highest cash flow is going to be in month 30.
Welcome to analysis of pass-through securities. In this activity, you'll explore pricing, yield, and risk analysis for mortgage-backed securities. The activity includes 5 steps and takes 60 minutes to complete. In step 1, you'll identify key risks like prepayment and reinvestment risk. In step 2, you'll calculate the yield to maturity for a pass-through security using market data. In step 3, you'll estimate monthly cash flows using a constant prepayment rate. In step 4, you'll analyze the concept of negative convexity and how it affects MBS behavior. In step 5, you'll interpret PSA prepayment benchmarks and their implications for investors. Let's get started and apply what you've learned in a hands-on way.
Now remember to project cash flows. One of the elements of your cash flow projections is the amount of principal that you are projecting will be prepaid in any given month. And remember how you get that. I said we need to get an SMM, a single monthly mortality. And once we have that single monthly mortality, we'll multiply that by the outstanding principal, because again, the single monthly mortality is an estimate of what % of the outstanding principal will prepay in that period. Well, how do you get a single monthly mortality from conditional prepayment rates, which remember is either how you express speed, or if you express speed on a PSA basis, you can convert that PSA speed into what conditional prepayment rate is implied by that PSA speed and what month you're in the life of the pool. But conditional prepayment rates are annual numbers, and yet remember, mortgages pay and therefore prepay on a monthly basis. So how do we convert an annual rate into a monthly rate? Well, you might say, well, you divide by 12. The problem here is that that misses the impact of compounding. Because again, some principal is being paid, even if there's no prepayments that month, there still is the amortization of principal. So the way you convert a annual figure into a monthly figure and take into account the impact of compounding is I would take 1 minus the conditional prepayment rate, where the 1 minus the conditional prepayment rate is raised to the 1/12th power. So that's how we'll accomplish that, in effect, monthly rate that nonetheless take into account the impact of compounding. And then once we have that SMM, we'll multiply that by the outstanding principal to estimate how much principal will be prepaid. And that's what we would add to the scheduled amortization of principal and the coupon on the outstanding principal when we're projecting the cash flows that we talked about previously. So if we assume we have a 9% conditional prepayment rate, and we've got a mortgage-backed investment, pass-through security, that had an original face amount of $10 million, but has a current factor of 0.9245787. This, by the way, is the way they express factors. Factors are expressed out to 8 columns to the right of the decimal point. And 9245, et cetera, well, you'll note it's a little bit less than 0.925. In other words, just a little bit less than 92.5% of the original principal is still outstanding. So I first need to convert my 9% CPR into an SMM, single monthly mortality. So if I take 1 minus the 0.09, 9% in decimal terms, and that 1 minus 0.09 I'm raising to the 1/12th power. Well, of course, that's 1 minus 0.91, 1 minus 0.09, 1 minus 0.91, where the 0.91 is raised to the 1/12th power, or 0.08333333, et cetera, which is this division of 1 by 12. So if I take 0.91 to the 1/12th power, that's that 0.9921, et cetera figure. So then I subtract that from 1, and here what I have is my single monthly mortality. In other words, 0.007, or approximately 0.782842%. In other words, just a little bit more than 0.75% of the outstanding principal is what we will be projecting to prepay, given a 9% conditional prepayment rate. So if I take the initial face amount of $10 million, multiply it by the factor, that says of the initial $10 million that were outstanding, there's $9,245,785.70 that has not yet been repaid. And that's what that is the outstanding principal. And again, by multiplying the outstanding principal by the SMM that we just calculated, that says, oh, we were going to estimate that of the 9.245, et cetera, million, that about $72,380 are going to prepay in that month. Now, moving on to another type of security. So the other type of security we're going to talk about, mortgage-backed security we're going to talk about, are what are known as collateralized mortgage obligations. And you might remember back at the beginning of the session, I introduced these as payout securities. So unlike pass-through securities, where all investors get their proportionate share, a pro rata share of each and every dollar, both principal and interest, that comes through the structure, remember, CMOs have a structured payout. Not only was there asset securitization to put together a bunch of sources of cash that ultimately we'll use to pay out to investors, but we've also structured the payouts. In other words, all investors are not going to receive a pro rata share of each and every dollar that comes through the structure. Rather, depending upon the tranche or class you're in, you're likely to have a different rate of interest and will repay principal according to a specified priority. So on pay-through versus pass-through securities, we're slicing and dicing and splitting up those cash flows to pay out according to some priority. And note that depending upon the type of security, there might either be a subordinated interest if it's a non-agency CMO, or a residual interest in an agency CMO. And the source of cash flows, well, that depends on what type of CMO it is, and we'll see the differences between agency and non-agency. But let's start out by talking about the simplest of all CMO structures. Those are what are known as sequential pay bonds, or sometimes simply sequentials. And what that means is that rather than all investors receiving a proportionate share of principal, will return principal in sequence. Initially, only the investors in the first tranche to receive principal will receive all the principal distributions, and only when that first tranche has received all of its principal back, there's been every last dollar of principal returned to them, then and only then will we start returning principal to the investors in the tranche to get return of principal second. And again, despite the fact there are other classes of investors, at this point all return of principal will be directed only to that second tranche until it's been retired in its entirety. Then and only then do we start returning principal to the tranche up next in the queue. So in all CMOs, there's a prioritized return of principal. But note what that does to the uncertainty that we talked about as the biggest risk for most pass-throughs. That is the uncertainty of the average life. Well, by self-selecting into a tranche that has an average life that's close to what you're hoping to invest for, you have a way of managing the prepayment risk, because you can self-select to be at the head of the queue if you want a relatively short-dated investment, that is, invest in a tranche that's supposed to get its principal back first or relatively early on in the structure's life. On the other hand, if you want a long-lived investment, and note a pass-through is not necessarily a long-lived investment, because remember my commentary about the big drop in interest rates back in the spring of '03, and investors in some 30-year pass-throughs got back 50% of their principal in the first year. Well, you could avoid a short return of principal like that by going into one of the longer dated tranches. That is a tranche at the back end of the deal that's only supposed to get its principal back after all of the other tranches or most of the other tranches have been retired. So the simplified diagram, which is reprise of something we had earlier on in the session. So there's a loan pool that is the ultimate source of cash, although there might be some intermediate structures we'll talk about over time. But once we're looking at the distribution of cash, it's likely that all investors, that is, investors in all the tranches, are earning some interest. Although, as we'll see later, some might not be paid immediately. It might be accrued rather than paid. But despite the fact that investors in all the tranches are earning or being paid interest, we're not going to return principal to investors in all the tranches. We're only going to return principal to the investors in the tranche that's supposed to get its principal back first. And only when the investors in that tranche have received a return of all their principal, then and only then will we start returning principal to the investors in subsequent tranches. So here we see in a bit more detail what I was just expressing in words with the simpler diagram. Because let's say that we have a CMO that has only 3 tranches and made up of entirely sequentials. Believe it or not, that is actually like the structure of the first CMO issued way back in the early 1980s. It had only 3 tranches and they were all sequentials. Nowadays, the deals are quite a bit more complex, and the reality is that multiple tranches can be receiving return of principal simultaneously, but obviously an in-depth discussion of complex structures is not appropriate for this program. But to talk through the basics of the CMO structures, if it was an all-sequential deal, it would work just as I described previously, but now we have it in a bit more detail. So we've got the CMO collateral pool, whether it turns out to be a pool of mortgages or it might be a pool of other interests in mortgages, which we'll talk about going forward. But we're assuming we have just 3 tranches, all sequential. So initially, investors in all 3 tranches are receiving interest payments, but principal is only being returned to the investors in tranche 1. But note, after tranche 1 is retired, that means they've gotten back all their principal, so they have no right to receive any additional interest because they only get interest on the principal that has not yet been returned. So once tranche 1 is retired, they receive no more cash flows. So since there's only tranche 2 and 3 outstanding, both of them will be paid interest, but now all of the principal distributions will be directed to tranche 2 until it's retired. And once tranche 2 is retired, then and only then do we start returning principal to the tranche 3 investors. So you can presumably see why these are called sequentials or sequential pay tranches, because the principal is returned in sequence. Initially to the shortest term tranche. When it's been fully retired, then and only then do we start returning principal to the next shortest tranche. When it's retired, then and only then do we start returning principal to the third shortest tranche, and so forth and so on until all the tranches have been retired. But now a little bit more detail first for agency CMOs. These are CMOs that are based on agency securitizations. And you'll note in an agency securitization, the collateral is not a pool of mortgages. The collateral for agency CMOs are agency pass-through securities. So let's say we've got 2 agency securitizations. One is Fannie Mae 4s and the other is Fannie Mae 3 3/4 or something like that. And let's say each of those mortgage pools were securitized, and against each of them were a number of pass-through securities were issued. Well, the collateral on an agency CMO is a pass-through security that represents a partial interest in a pool of mortgages. You'll note in my diagram, the CMO collateral pool includes two pass-throughs, each of which represent partial interests in two different pools of mortgages. And note, this doesn't capture the full complexity, because sometimes agency CMO collateral pools will have interests in a dozen different mortgage securitizations. In fact, they can even have tranches of other CMOs. That's what's called a re-REMIC, by the way. So again, the idea is agency CMOs will have in the collateral pool mortgage-backed securities. So it's not the pool of mortgage loans that's the collateral, it's the specific pass-through securities that were bought specifically to be collateral and sources of cash flow to investors in the agency CMO. And also remember a comment I made earlier when I was comparing cash flows on pass-throughs to cash flows on pay-through securities like CMOs. You'll note in my diagram, I've got, again, a three-tranche structure, and I'm assuming they're all sequentials initially. And you'll note I'm showing interest payments being made to all three tranches. Also, implicitly, none of the tranches have been fully retired. Let's say this is the first period for distribution of cash. You'll note I've tried to draw the arrow showing the return of principal to the tranche 1 investors, not in red, but rather in red and blue, because any of the cash left over after we pay our administrative fees and expenses and pay the contractual rates of interest and all the other tranches, any of the monies left over, whether they were received as a payment of interest from the collateral or return of principal from the collateral, any money left over after we pay the contractual rates of interest on all the outstanding principal, all money is left over, whether it was received as a return of principal or received as a payment of interest, any money left over will be distributed in its entirety as a return of principal to investors in the currently paying tranche. Because remember, when money washes through a CMO structure, it doesn't have to retain its original characterization as either interest or principal. These are pay-through structures. All the money left over after we pay our fees and expenses and contractual rates of interest on the outstanding debt, any money left over is distributed as a return of principal to the investors in the shortest dated tranche. Let's look at that situation a little bit more closely and put some numbers on it. So let's say we have a collateral pool that consists of just a single pass-through security. So I'm assuming there was a $500,000 mortgage pool with a 4% pass-through rate. And let's say that pool was sold to three different investors, that is pass-throughs with three different original face amounts. One investor bought $250 million worth, another investor bought $150 million worth, and we bought $100 million worth to serve as collateral on an agency CMO. So that's our collateral pool, one pass-through for $100 million carrying a 4% pass-through rate. Now, of course, on that pass-through, when the mortgage pool distributes the principal and interest, that means our collateral pool has collected the principal and interest on that collateral. And remember how we're going to pay it out. We're going to pay interest on all the outstanding tranches. The cumulative face amount of all the tranches will equal the original face amount of the collateral pool. So since we have a $100 million original face amount and then current face amount initially as our collateral, there's $100 million par value of principal. But note, none of the tranches in the CMO have the same interest rate as the pass-through security acting as collateral. By happenstance, one or more of the tranches might have the same interest rate, but it's also possible, like in my example, none of the tranches have the same interest rate as the underlying collateral. So again, what we'll do is we'll pay interest on all the outstanding principal. So if this is the first month, that means tranche 3 gets their 4.25% rate on $50 million. Tranche 2 gets their 3.5% rate on $30 million. Tranche 1 investors get 3% on $20 million. I haven't shown the exact dollars, but I've shown you the methodology for calculating the dollar amount of interest payable on each of those tranches. Note they use a 3360-day count convention because that's the convention for U.S. mortgage-backed securities. but that again, any money left over after we pay the contractual rates of interest as well as our administrative fees and expenses, any money left over is going to be payable to investors, distributed as a return of principal to the investors in the shortest dated tranche. And let's assume there was $500,000 left over after paying our contractual interest on the tranches and administrative fees and expenses. Well, that means the investors in tranche 1 get back $500,000 of their initial principal. And note, since they got back $500,000, do this in millions, and the initial face amount of the tranche was $20 million, in effect, the investors in tranche 1 each got back 1/40th of their original principal. So this is not we're retiring certain bonds at their face value. Every investor in the current paying tranche is getting their pro rata share. In other words, if we did this per $1,000 face amount, because like other bonds, CMOs are often sold in increments of 1,000 par, 1/40th would be $25. So every investor in tranche 1 has gotten back 25 of the original $1,000 face value. And you'll note, by the way, how that's consistent with the factor. Since each investor in tranche 1 got back 2.5%, 1/40th, 2.5% of the original principal, that means 97.5% of the original principal is still outstanding. You'll note for tranche 2 and 3, they both still have factors of 1 because none of their principal has been returned. Now, if we consider the second month, note we've got the same structure, but we have to take into account that for tranche 1, some of the principal has been returned. So let's say in month 2, again, we collect the principal and interest from the securitization on our collateral. The cash flows on the collateral is then available for distribution to the investors in the various tranches after administrative fees and expenses. And so again, we'll pay interest on all of tranche 3 and all of tranche 2. You'll note the interest calculations for them in month 2 are exactly the same as they were for month 1. But note the investors in tranche 1, they're not getting their 3% on the initial face amount. They're getting their 3% only on the $19.5 million that hasn't yet been returned to them. And let's say in month 2, there was $1 million left over after payments of the contractual rates of interest and administrative fees and expenses. Well, that means that full $1 million get paid to the tranche 1 investors, which you'll note means in the following month, they'll only be getting their 3% coupon on $18.5 million. And you'll note since in that second month, they received $1 million on an initial face value of $20 million. That is, they got back 5% of their initial face amount in the second month. Well, that's why the factor fell from 97.5 to 92.5. Since they got back 5% of their original face amount in that second month's principal return, that's why the factor for tranche 1 fell by 5%. Now, while sequentials are still commonly encountered in CMO structures, you would almost never see an issuance in recent decades that was made up of entirely sequentials. Invariably, CMO structures will include Z-bond tranches, floating rate tranches, inverse floaters, PAC bond tranches. So let's introduce some of those other sorts of tranches, at least some of the more commonly encountered ones. So Z-bond tranches are very commonly encountered in both agency and non-agency CMOs. And the Z in Z-bond tranche, I guess, is a reference to zero, as in zero coupon bond. I don't want to push the analogy too far, because I'm not saying Z-bond tranches work just like zeros. I'm just trying to explain where the Z in Z-bond comes from. However, Z-bonds are also referred to as accrual bonds, and I think that is a better descriptor of how these bonds actually work. Because with a Z-bond tranche, while you'll be earning interest from the very beginning, it will not be paid out in cash initially. Rather, initially, that interest earning will be recognized simply in sort of a bookkeeping accrual, although that's not to say you're not really getting it, you're simply not seeing it in cash immediately. So that earned but unpaid interest will in effect be added to face amount, so in subsequent periods you'll be earning interest not only on the original principal, but you'll also earn that same rate of interest on the interest earned in previous periods, which has been added to the face amount. So if you happen to be familiar with payment in kind or PIK bonds from the corporate bond market, Z-bond tranches work just like PIK bonds do. If you're not familiar with PIKs, don't worry, because I'm going to describe Z-bond tranches in a bit more detail and give you a simple number example. Now, think of the implications of earning interest in the fashion I've described. Not paid to you in cash, but rather the interest earned but not paid is added to the face value. That affects both the risk and potential return on investment in, well, ways that, depending on your expectation about interest rates, may or may not be a good thing. Because that means these Z-bond tranches have much less reinvestment risk than a sequential located in the same spot in the deal. Because a sequential would be receiving interest each period, which means you'd have reinvestment risk, because that means you'd have to reinvest those cash flows at whatever interest rates are available at the time you receive the money. Where with a Z, initially there's no reinvestment risk because you're not paid out any cash until all the shorter dated tranches are retired. So that avoidance of reinvestment risk is a good thing or a bad thing? Well, the right response is like the response to most difficult questions, it depends. If interest rates go up, you'll be sort of unhappy that you didn't receive the cash because you're not now able to reinvest it at that higher rate of interest. It's automatically reinvested at the same rate the tranche originally carried. On the other hand, if rates go down, you'll be very happy not to have cash that you need to reinvest at those lower rates of interest. So we can't say whether avoidance of reinvestment risk is a good or bad thing. That depends how rates move in the future. But we can definitely identify the fact that until you start receiving cash, the interest that's earned is simply added to the face amount of the security, earning the same rate of interest as the original principal. We know that that's one element of uncertainty that's not there. But realize, of course, when you take away one dimension of risk on an investment, there's usually one of two consequences. Either if one element of risk is reduced, the expected return declines, or if one element of risk is reduced, some other element of risk is increasing to offset that reduced risk. And so the expected return is not adversely affected. And in this case, it's that latter that applies to Z-bond tranches. Because while not receiving any cash period by period early on means you don't have any uncertainty about the rate at which you'll reinvest it, the back-end loading of the cash flows, the fact that you're not going to receive any cash for some period of time, means that the value of the investment is much more sensitive to an interest rate change. So you have less reinvestment risk, but you have higher duration. That is an investment whose value is more sensitive to interest rate changes. And in addition to talking about the risk, we also want to talk a little bit about what's the impact of the Z on the cash flows to the other tranches in the deal, in the structure. But let's look at a diagram to talk about that. So here I have a hypothetical three-tranche structure again. But now while tranches in 2 are sequential pay, that's the implication of the SP, tranche 3 is a Z-bond tranche. So note how I have the cash flows before any of the tranches are retired in the first panel. In the second panel, what happens after tranche 1 is retired. In the third panel, what happens after tranche 1 and 2 are retired. You'll note in the first panel, before any of the tranches are retired in full, I'm only accruing interest on the Z. That's the implication of the dashed line. There's a recognition of value, the increase in the face value, but there's no actual payout of cash. Whereas since tranche 1 and 2 are sequentials, they're receiving interest payments. And again, since this is a CMO, any money that's left over, whether it was interest or principal when it was paid off the collateral, any money left over is what is the source of funds to return principal to tranche 1 investors. Once tranche 1 has been retired its entirety, well then we'll start returning principal to tranche 2 investors, but you'll note still, since there's tranches outstanding ahead of the Z bond tranche is only accruing interest. All the cash flows at this point would be going to tranche 2. Pay interest on the outstanding principal, any money that's left over, return as much additional money as possible to reduce the principal owed to the tranche 2 investors. And it's only when all the shorter dated tranches are retired that the Z becomes the current paying tranche, at which point they will start receiving their coupon rate of interest on the stepped up face amount, the increase in the face that reflected all the accrual of interest in the earlier periods. And of course, once the Z becomes the current paying tranche, not only are we paying interest on it, but we're also returning principal to the Z bond tranche investors. And to give you a clear idea of that accrual of interest and how it's reflected in an increased face amount, let's look at how the Z-bond tranche face would increase over time, at least over a couple of periods. So let's say in that last example, the Z-bond tranche had an initial face value of $10 million, and let's say it paid a 4.5% rate of interest. Now remember, as long as the shorter dated tranches are still outstanding, the Z-bond investors will not be paid cash, but nonetheless they'll still be earning it period by period by period. And if that sounds rather bizarre, you're going to earn interest but it won't be paid to you, so is there any real value there? Well, this is the illustration. So since our initial face amount was $10 million in the first month, we'll get 4.5%, our coupon rate on that $10 million, again times 30 divided by 360, because that's the day count convention in the mortgage-backed securities market. That means in the first month, the Z-bond tranche investors in the aggregate earned $37,500 of interest. Well, that means the factor, which was initially 1, will now be stepped up to reflect the interest earned by the Z-bond tranche investors in that first month. So the factor goes up to 1.00375, but that means our principal going into month 2 is not simply the $10 million initial face, it's the $10 million initial face stepped up by the $37,500 of interest earned in the first year. So it goes going forward. So in our second month, we now earn that same coupon rate, but now in the stepped up face. So 4.5% on $10,037,500, adjusted for the monthly distribution, is $37,640.62.5. So we'd step up the factor reflecting the addition to face, and you'll note now our face amount going into the third month is the initial $10 million plus the $37,500 earned in the first month plus the $37,640.625. So you'll note that going into the third month, our face amount is now up to $10,075,141.06, and the amount over $10 million is simply a summation of the interest earned over the first 2 months. So period by period by period, the face amount of the Z gets stepped up by the interest earned not paid, and the only cash flows will only begin to be distributed to the Z-bond tranche investors once all the shorter dated tranches have been retired, at which point the Z-bond becomes more like a sequential pay. Let's now turn to the other most common type of tranche, which are PAC bond tranches. And PAC, which is their common name, is of course an acronym for Planned Amortization Class. As the name implies, there is an amortization schedule. In other words, for every PAC bond tranche, there's a schedule according to which we will attempt to return principal to the investors in the PAC bond tranche. So note how I expressed that. I didn't say that the amortization schedule was guaranteed, that no matter what, the PAC bond investors would get their principal returned exactly according to that schedule. It simply means that once we're in the period of time when the amortization schedule is in force, in other words, when the principal is supposed to be returned, what they'll refer to in the business as the window or the PAC's window. Well, once you're in the window, once you're in that amortization period, then in effect the PAC bond tranche investors go to the front of the line. So even if there were shorter dated non-PAC tranches outstanding, nonetheless the PAC bond investors would be at the front of the line to get their principal back first, and only after the PAC bond investors got the amount of principal they were supposed to get that period could you go back to the original priority of return of principal to the other tranches. But note there is no guarantee. If prepayment rates in that instance were to be so slow, remember I said there were still shorter dated tranches outstanding, if prepayments were so low that, or payments and prepayments were so low, that we couldn't even afford to give the PAC bond investors their full amortization of principal, well, there are no other sources of cash to dip into because these are pay-through structures. But if we're in arrears in terms of honoring the PAC bond's amortization schedule, that's not forgotten. So when we go to a subsequent month, the PAC bond investors are still at the front of the line to get the return of principal, but they're there not only to get the amortization of principal that was due that period, they also stay at the front of the line until any previous arrearages are made up. And only once you get back onto the amortization schedule, assuming you still have money left over, could you go back to directing return of principal to other non-PAC tranches. Now, aside from those issues related to the amortization schedule, which we'll look at more closely in a few minutes, some other considerations to make sure you're aware of. Most of the time, there is going to be a lockout when there's a PAC bond tranche or PAC bond tranches in the structure. Now, lockout has different meanings depending upon the context in which it's used. If you're using the word lockout in connection to a CMO that has no PAC bond tranches, lockout simply means relative to the tranche you're analyzing, there's other tranches ahead, other tranches that are supposed to get their principal back first. But when you use the word lockout in the context of PAC bond tranches, that means what length of time before the first scheduled amortization payment. And that's quite typical in structures we've seen in recent decades. In the vast majority of time, there's somewhere between a 3 to 5 year lockout. That is 3 to 5 years before the first scheduled amortization payment to the PAC bond investors. It turns out that the structures tend to be more robust, that most of the tranches are going to have less unpredictable average lives when you have a lockout in the structure. And one of the features of deals that include tranches with amortization schedules like PACs is there will also be tranches without amortization schedules, and that's what they refer to as companion tranches, or sometimes support tranches, because it's those tranches that in effect are soaking up the uncertainty of the average life that you're taking away from the PAC bond tranches. Because given that the collateral is pass-through securities that give you a claim against a pool of mortgages, or maybe multiple pools of mortgages, you have that amount of uncertainty associated with the pass-throughs. Well, if there is that amount of certainty to be divided amongst all of the tranches in a CMO deal, to the extent you're reducing that average life uncertainty for some investors, it doesn't disappear. The uncertainty of average life you're taking away from some tranches of necessity is being dumped on the other tranches. That's in effect the purpose companion tranches serve. They're soaking up the uncertainty. That is, the companion tranches will have much more unstable average lives, but that's the offset to the reduced uncertainty of the average life for the PAC bond investors based on that amortization schedule we talked about before. So in other words, PAC bond investors are not absolutely protected, but have fairly significant protection from a shortening of the average life, which occurs in a high prepayment rate environment. In other words, PAC bond investors have protection from call risk. Not absolute, but a reduction in that exposure. And similarly, PAC bond investors are also not likely to see the average life of their investment extend very dramatically, which happens in a slow prepayment rate environment. That is, they're protected from extension risk. So PAC bond investors, in effect, have two-sided protection. Protection both from an extreme shortening and an extreme lengthening of average life. In fact, most of the time, PAC bond tranches are retired exactly according to the amortization schedule. So let's look at an example with a PAC bond tranche in it under two different situations. One that's a relatively slow prepayment rate environment, the other that's a relatively high prepayment rate environment. So let's start off with, say, a relatively high prepayment rate environment. So the setup is this is the same CMO deal, but under two scenarios. So in the left-hand panel, we've got this 5-tranche structure. Tranches 1, 2, and 4 are sequential pay. Tranche 5 is a Z. The PAC bond tranche is the third tranche in the structure. In fact, this is very similar to the first time a PAC bond tranche was part of one of these CMO deals way back in the early 1980s. So let's say the PAC amortization schedule runs from the 12th month of the 5th year, that's the 60th month after the deal was syndicated, all the way up to the 84th month, that is the 12th month of the 7th year. And this is actually fairly consistent with PAC windows. PAC windows are typically either 1 or 2 years, and this is just a hair over 2 years. And mostly on these amortization schedules, there's an equal return of principal month in, month out over the life of the window. So given we have a 25-month window, normally that would mean that the amortization schedule specifies getting back 4% of their original principal per month. Well, let's say we come up on only month 40. In other words, we're actually I should say a year and 2/3 before the first scheduled amortization payment. And yet, let's say that prepayments have been so high that all of Tranche 1 is retired and there's only a little bit of Tranche 2 principal still outstanding. All right, so it's time to, we've collected cash from the collateral, it's now time to make the distribution. We accrue interest on the Z, pay interest on all of tranche 4 and all of tranche 3 because they've gotten no dollars of principal returned to them yet. And we'll also pay principal on the little bit of tranche 2 principal still outstanding. Now, since tranche 2 is second in the queue, they're the next one to get return of principal. But let's say there's so much money left after paying the contractual rates of interest on all those tranches that there's more than enough money to return all of the remaining dollars of principal owed to the tranche 2 investors. There's more than enough money to return all of the principal to the tranche 2 investors, and so consequently, now tranche 2 has been retired in its entirety. Now, if these were all sequentials, the next tranche to receive return of principal would be tranche 3, but tranche 3 is a PAC, which means in effect we'll skip over tranche 3 and start returning principal to the investors in tranche 4. So now going forward, accrue interest on the Z, pay interest on the remaining portion of 3, pay interest on a remaining portion of tranche 4, pay interest on all of tranche 3, and again, return of principal to the investors in tranche 4. We're not going to return principal to the tranche 3 investors until we get into the window, unless there's no other principal still outstanding. If there's no other tranches, nowhere else to send the money, then at that point we have to return the principal to the tranche 3, the PAC bond investors. In fact, if tranche 4 was retired in its entirety before we get into the window, even though tranche 5 is a Z-bond tranche, tranche 5 would become the current paying tranche. And we'd start returning principal as whether paying interest to the Z-bond investors. The only way the tranche 3 investors get any return of principal before the beginning of their window is if all the non-PAC tranches have been retired. Well, let's consider an alternative scenario. That is, what happens if we're in a relatively slow prepayment rate environment? So we'll assume the same CMO structure, the same PAC bond tranche with the same repayment or amortization schedule, but now let's assume we're in a relatively slow prepayment rate environment. So we get to month 60. And while all of tranche 1 has been retired, there is still some of the tranche 2 principal outstanding. Nonetheless, after we pay our administrative fees and expenses and accrue interest on the Z, pay interest on all of tranche 4 and 3 because all their principal is still outstanding, and pay interest on the principal of tranche 2 that remains outstanding, when it comes to return of principal, we'll first return principal to the investors in the PAC bond tranche because once you're in the window, the PAC bond tranche is at the front of the line to get their return of principal. It's only if we were able to make the full return of principal to the PAC bond investors and still had money left over that we go back and return principal according to the original priority. And this is also where I said earlier that what happens if when it comes to returning principal to the PAC bond investors, prepayment rates are so slow that we can't give them their full allocation. Remember I said that given it's a 25-month window, the likelihood is that the PAC bond investors would be expected to get back 4% of their principal each month? Well, what happens if in month 60 we can only return 3% of the original principal to the PAC bond investors? Well, guess what? That means when it comes to next month, the PAC bond investors would be due not only the 4% of principal that they were due according to schedule, they would also be due to get the 1% underage from the previous month's amortization, and only if the payout could cover the amount to be amortized this month as well as any underpayments for previous months, only if we could get back on schedule would we go and return any principal to the investors in tranche 2. So let's briefly consider some of the other types of tranches one is likely to encounter in CMOs. Well, we'll talk about tax in some detail, and I'll discuss them when we look at the next exhibit because there's an exhibit that has a diagram that supports the discussion. But for the moment, you can think of tax, and TAC, like PAC, is an acronym. The A and the C stand for amortization schedule. It's just that in this case, the T stands for targeted amortization class. Now, the name is not very descriptive. You have to understand industry jargon and what this means. But this means that like a PAC, there's an amortization schedule for a TAC. But unlike a PAC, you don't have two-sided protection. Remember I said PACs get protection both from call risk and extension risk? Well, TACs are only going to have one of those two. But let's briefly talk about some other types of tranches you might encounter or mortgage-backed securities. So note that many deals include floating rate tranches. Well, it's just like the other tranches in terms of return of principal, but rather than paying a fixed rate of interest, they pay a rate of interest that adjusts over time. So like other floating rate instruments, there'll be some coupon formula. It's going to be some index rate like LIBOR plus a differential, maybe 55 basis points. And the interest rates on those tranches move up and down with that index rate. Now, that would be fine if the collateral pool is made up of adjustable rate mortgages, but most of the time the collateral pool is made up of fixed rate mortgages. So consequently, if we have fixed rate mortgages and yet we've issued some floating rate tranches, one could imagine a potential for problems. If market rates rise, the money owed to the floating rate tranche investors will keep increasing. And if it rises enough, we might not have enough money to cover all of the interest payments owed to investors. So normally, anytime you see a floating rate tranche issued against fixed rate collateral, there's also going to be an inverse floater. As the name implies, this is a tranche whose interest rate will move opposite from the direction market interest rates are moving. In other words, interest rates go up, the interest rate payable on an inverse floater is going to decline, and vice versa. And it's not that the inverse floater has a big constituency where there's lots of investors interested in owning floating rate instruments. The market for inverse floaters is much smaller. But the purpose of the inverse floater is simply to hedge the building of the floating rate tranche in the structure. And there's also what are known as stripped mortgage-backed securities. Interest-only strips and principal-only strips, and the names are very descriptive. If I have an interest-only, also known as an IO strip, I simply have the right to receive some share of the interest coming off of the collateral. Conversely, if I have a PO strip, I don't have the right to receive any interest, but I get a set share of all the principal that comes in off the collateral. But let's look at TACs a little bit more closely. So here you see a diagram that tries to capture the implications of a TAC bond tranche. Now, I'm comparing this with a PAC that we talked about earlier, and let's assume these are TACs that have the same amortization window. That is a 25-month window. They're supposed to get their principal back in equal installments starting in month 60, running all the way through month 84. Now, remember with a PAC, I said we had two-sided protection. We're protected from call risk how? Well, if all the shorter dated sequentials are retired before we get into month 60, we'll jump over the PAC and start retiring the longer dated non-PAC tranches. That's how the PAC is protected from call risk. The PAC is also protected from extension risk how? Well, extension risk happens when prepayment rates are really slow and there are still shorter dated tranches outstanding once we get the window. Well, nonetheless, we'll leave that principal outstanding and start returning principal to the PAC. TACs are like one-sided PACs. They will not have protection from both. They'll have protection from one or the other of call risk or extension risk. And given the history of the mortgage market, and for most of the existence of the mortgage market, we've lived in a period of declining interest rates, the market has become much more sensitive to call risk. And so the most common type of TAC gives protection from call risk, but not from extension risk. In other words, in a high prepayment rate environment, if we retired all the shorter dated sequentials, we'd skip over the TAC and start retiring longer dated sequentials until we got in the window. So such a TAC would be protected from a shortening of the average life, but would have no protection from extension risk. In other words, in a slow prepayment rate environment, there might still be principal outstanding on shorter dated sequentials when we hit month 60. Well, guess what? The TAC in that case gets no consideration. We'd keep paying off those shorter dated sequentials and wouldn't start returning principal to the TAC until all the shorter dated sequentials were retired. Now, that is by far the most common type of TAC given the history of the mortgage market, but occasionally you see a TAC with the opposite sort of structure. That is protection from extension risk, but no protection from call risk. Those are sometimes called reverse TACs because they have the opposite structure of the most common type of TAC, but be careful. It doesn't have to be called a reverse TAC. Sometimes they'll just use the acronym TAC no matter which of these two types of structures they're talking about. But in that much less common structure, you're protected from extension risk but not from call risk. In other words, in a high prepayment rate environment, if we retired all the shorter dated tranches and even though we were not yet in month 60, nonetheless we'd start returning principal to the TAC bond investors because the second type has no protection from shortening. On the other hand, in a slow prepayment rate environment, that's where that sort of TAC would get some protection. That is, in a slow prepayment rate environment, there might still be principal on shorter dated tranches outstanding. And once we hit month 60, well, despite the fact that there's still some principal on those shorter dated tranches outstanding, we'll start returning principal to the TAC bond investors according to that amortization schedule, because that structure protects from extension risk. So I hope you feel like you've gotten a lot of good information out of a wide variety of mortgage-backed security structures, both pass-throughs and CMOs, as well as many of the surrounding issues and concept as it relates to the evaluation and investment characteristics of mortgage-backed securities. So I hope it's been very helpful.
Welcome to Collateralized Mortgage Obligations. In this activity, you'll design and analyze a CMO structure using a simplified mortgage loan pool. The activity includes 5 steps and takes 60 minutes to complete. In step 1, you'll describe the roles of sequential pay, Z bond, and PAC tranches. In step 2, you'll create a basic CMO structure and explain how payments are distributed. In step 3, you'll simulate how prepayments affect the timing of payments to each tranche. In step 4, you'll introduce a PAC tranche and explain how it maintains cash flow stability. In step 5, you'll match investor profiles to the appropriate tranche types based on their risk preferences. Let's get started and apply what you've learned in a hands-on way.
Hi, I'm Paul Siegel. I am one of the creators of this course, and I hope you really enjoyed it as much as I did creating it. We worked closely to try to create a curriculum that made sense, that was really practical, and that was relevant to someone in your shoes, someone who is learning something new or expanding their knowledge of what they've just been doing but really wanted to brush up on. The goal of these educational pieces is to keep them rather simple, not to do high production value content creation or with lots of bells and whistles, but to really get to an instructional experience where you might be sitting in the classroom, which is how most of us have learned our entire lives. Yes, the virtual world has changed much of that, but at the end of the day, it's all about working with and learning from a top quality expert. And that's what we've hoped to do. In this program, you will see that there are many examples. There are many practical tips and tools that you can use, hopefully, after you go away from the program. But we're adding more content all the time, and we're trying to do that so that it's effective. So what I'm asking you to do is leave comments, message us, message me, and we will be able to get you more content, more relevant exercises, and more practical things that help you use this course as a tool on an ongoing basis, not just the one time you go through it, but you want to come back to it because we'll add more exercises and things to help you do better at what you're doing right now. I want to point out that sometimes, as I mentioned, there are imperfections in a course. There are pops, there are clicks, the sound sometimes get muffled because an instructor happens to have covered their microphone by accident, or it slips off, or something of that, or the camera person gets out of focus, or all those sort of things. I think the fundamental truth about education is it's partially what you learn in the classroom, but it's partially about altering the way you think about problems. And as anyone will tell you, you go to college or you go to a training course, not so much to gain what you're going to learn in the course, but to think about the problem differently. So I hope that for the most part, our courses do communicate how do you solve problems. We are doing our best to add more exercises and quizzes and things that give you the hands-on talent and knowledge and skills that you need to perform effectively. But more importantly than anything else, I hope you step back, think about what you've learned, and try to apply that in the real world. And I think you'll find that most of our programs, if not all of them, do that. They're really hands-on and practical, and they're trying to give you good insights into how to become more effective in your career.